geography, but as best we can tell, demand remains robust across product lines and across geographies. We're again expecting 20% plus growth across really all the product lines as we move into this quarter, and I think solid growth across geos as well.
I'm going to make some news here, Will Power. Your target's a 155, but what's your sum of the parts valuation when you break this down and you value services and all the rest of it and all the products and that? What's your sum of the parts statistic?
Yeah, well, Tom, that's a good question. Look, I think one of the things to call out here is if you look at wearables and services on a combined basis, that's almost $100 billion, business.
How much is that per share? If wearables and the stuff Lisa buys, how much is that per share?
Yeah, well, I'd have to go back and do that math and come back to you.
Oh, come on, you know it cold.
On a per share basis, but I can tell you on a revenue basis, it's almost a third of the business, and on a combined basis, growing north of 20%, right? And that's what's helping drive this mix shift.
Yeah, all I can say,
He talks like an economist. We're not going to get a straight answer out of Will Power.
Tom, all I can say is that my tech cash is probably less robust than vet bills. There is a question, if you want to talk like an economist, Will. When you zoom out, a lot of people say, especially with tech stock valuations, they've gotten somewhat divorced from fundamentals. Yes, fundamentals look amazing, and yet the valuation is hinged very much on yields remaining this low, on inflation remaining low. What's your view on that? How vulnerable are Apple's shares to the idea of yields moving?
Okay, traders, position opened on euro at 120.71. Okay, if you want to follow this trade, you already opened position, so stay with me, and I will guide you through all these, when we're going to place stop and profit, when we're going to fill the trade, when we're going to execute. Stay with me, okay? And I'll speak to you later. Okay, bye-bye.
Impact on the true high growth names. Apple's growing at a much faster pace right now. But I think by and large isn't seen still as a double-digit long-term grower at this point.
Will, when you talk about taxes, what would have a bigger impact in your view? A higher overall tax rate, or closing some of the loopholes that big tech companies have enjoyed to evade or to get away from some of the high taxation rates?
Yeah, that's a good question, and I'm not sure I have the perfect answer to that. I think it's probably the higher tax rate overall. And again, I think as Apple points out, they believe they're the highest corporate taxpayer in America, already, right? So it suggests at some level they're not using perhaps every single loophole that perhaps they could, but all companies are always going to look to try to maximize, right, their profits.
Well, Mrs. Keene emails in, and she wants to know, a hitter like you, when you go to these road shows and you do all your Apple chit chat and all that, do you get like the Hermes watch swag? Do you get like the watch bands from Hermes at $489 for the watch band?
No, I'm like everybody else. I'm still paying for it. If you want to talk to Tim Cook about that for me, that'd be great. I'd love to be able to test out some of those products.
We'll do that when we talk. I'm sorry, Lisa. That just says, $489, Lisa, is a watch band. That says Lisa Abramowitz.
Oh yeah, you know me. It's basically, how much is that AirTag again, John? You said it was something like $400.
What happened to this conversation this morning? Well run, Will Power, BET Senior Research Analyst. Thank you, sir. Thank you very much.
See what we did there, John? This is really important. We're going to do Apple earnings here, and it's going to be margins and iPod and that and all that. The adults are looking at the use of cash, John, and the use of cash, like you've mentioned through the morning at Google, is just extraordinary.
There's a big change at Alphabet, though, Tom, under Ruth Porat as the CFO. We've got to underline that. Porat's really driven that change too. And they're still going to invest a ton of money into that company as well. That's not going to be a major shift over at Alphabet. But the buyback and the capital returns, and I think Tim Cook did the same thing over at Apple. That's what's amazing about Apple. When Tim Cook came on board, we talked about innovation without Steve Jobs, and he just turned it into a balance sheet machine. Just turned it into a capital returns machine, Tom, and just literally minted money for investors.
John, I mentioned the Hermes watch band, and I get an email from Mohammed Al-Arian.
What did Mohammed say? Did Mohammed
he thought I was trashing on economists, and I wasn't.
Is that what he thought?
I couldn't get a straight answer out of Will Power. It sounded like a conversation with Dr. Al-Arian,
Oh, you're punchy this week, aren't you?
I am.
Why? What's wrong?
The Red Sox beat the Mets. Okay,
so you're
the
doing
Red
well.
Sox beat
What's
the
wrong
Mets.
with you?
I'm feeling good.
If this is the good version of you.
Yes.
That is worrying, isn't it, Lisa?
Red Sox beat the Mets. The dreaded Mets.
Not to take a conversation away from this, you guys can keep going. But John, there was something that you said in your market check that I thought was really interesting.
That got cut off by Tom really early. Please, Lisa, please carry on.
Hold on a second. Where you were talking about how it's the 5% rally that's the least appreciated rally ever, the 30% rally in Alphabet shares.
I think a quiet rally, just not being talked about. Yeah.
Very quiet rally. Because it's not traditional. It doesn't have the hallmarks of the bull market in the same kind of way. I was looking at the Russell 2000. It's up 2% this month. It's underperforming dramatically the S&P 500. Bond yields are lower on the month. The idea here that people are ratcheting back. Right.
Yeah.
So we have these things that are sort of suggesting slower growth ahead or a peak in markets, while the likes of Apple shares are up by 9.3%. So the sort of staples, the cash cows are the ones doing best. And that, I think, is underpinning the lack of enthusiasm behind this 5% rally.
The cyclical rally stalled, but the equity market returns have continued.
Right.
What on earth is in your mouth, Tom?
Wait.
What is that? Have we muzzled him now?
Who did that?
This is an improvement, I've got to say.
The mute button to a muzzle.
But I'm pleased that you were paying attention, Lisa, at 6:30 a.m. because my other colleague was not. Coming up, Lawrence Sauer, Johns Hopkins Associate Professor of Emergency Medicine. Might just be Lisa and I for the next 2 hours, which might be an upgrade from New York City this morning. Good morning. Equities look like this on the S&P 500. Futures advanced 5 points, up a little more than 0.1%. Yields up a couple of basis points, 164 on 10, still about 10 basis points from the closing high of the previous month at the end of March. In the FX market, euro dollar down 0.2%, 120.69. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden goes before a joint session of Congress tonight to try to sell his historic spending plan. The president wants money for childcare, universal pre-kindergarten, and tuition-free community college. He plans to pay for it with tax hikes aimed at high-income earners. Republicans already have announced their opposition, and some progressives are calling on the president to do more. British Prime Minister Boris Johnson faces an investigation into the refurbishment of his Downing Street apartment. The Electoral Commission says, quote, an offence or offences may have occurred. There are reports that the makeover was originally funded by Conservative Party donors. In South Korea, the billionaire heirs to the Samsung fortune outlined a long-awaited plan to pay one of the largest inheritance tax bills in history. It's an asset transfer of $11 billion that will take place over several years. When Lee Kun-lee died last year, he left a fortune of almost $21 billion. And Saudi Arabia is in talks to sell a 1% stake in Saudi Aramco to what's described as a leading global energy company. The sale could be worth about $19 billion, according to Crown Prince Mohammed bin Salman. The kingdom is looking at a deal as a way to lock in customer demand for the country's oil. Google's first quarter results show a surge in ad sales related to travel and retail. Businesses are boosting digital marketing to capture a public eager to resume some sort of normal life. Google parent Alphabet posted revenue that blew away Wall Street estimates. The company also unveiled a big new share buyback. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Rishka Gupta. This is Bloomberg.
minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe and give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the US, we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
President Joe Biden, nearing 100 days in office, addresses a joint session of Congress. COVID, the economy, the plan forward. Wednesday, 8:30 p.m. on a special edition of Balance of Power on Bloomberg Television and Radio.
Bottom line is clear. If you're vaccinated, you can do more things more safely, both outdoors as well as indoors. So for those who haven't gotten their vaccination yet, especially if you're younger or think you don't need it, this is another great reason to go get vaccinated now.
That was the President of the United States. We'll pick up on that in just a moment. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Wednesday morning, the price action looks like this on the S&P 500. Equity futures on the S&P going into the Fed and an address from the President of the United States to Congress later this evening. Up. Equities up 3 points. We advance 1/10%. Yields higher by a couple of basis points too. 164.13. Euro dollar in 0.2%. 120.67. We'll talk about the science in a second, Tom. But let's talk about the reaction of, I think, most people yesterday to that address from the president. That is not exactly the marketing material that I think Get Vaccinated America probably required yesterday. If you get vaccinated, you don't have to wear a mask outdoors. I'm not sure that gets it done.
We get the embargoed copy, and I'll be honest, John, about 3 hours before the announcement, I looked at the embargoed copy and went, really?
Is that it?
Is that it? Lauren Sauer joins with serious expertise on this. Lauren, this goes back to the giant Frank Ramsey in the 1930s, the advent of game theory through World War II, and Prisoner's Dilemma found by the Rand Corporation in 1950. We are back to the game theory of how we get out of this pandemic. Are we doing a prisoner's dilemma with our masks, or is it going to be a game of chicken?
I think we're going to have to wait and see on that one, but I agree with you. I think we would have liked to have seen a little bit of stronger guidance, a little bit more opening from the CDC, maybe some more statements around what we can safely do indoors. Maybe the message around you can take your mask off if you're outside with family members who have already been vaccinated, and so on and so on and so on. I think we would have liked to shore that up a little bit and just have a clear, concise message on what we can and can't do now.
What does May bring? I mean, April dashes to an end here. What do you and your team at the Johns Hopkins University, what do you perceive our May will look like in terms of vaccination reaction functions?
I think we're going to see a lot more things opening up. I think we're going to see a lot more people moving outside and feeling comfortable doing larger activities, sort of pushing the limit of what those small gatherings are. I think the guidance does help with that, you know, knowing that if you're vaccinated, it does feel safe. And the CDC looks at it as safe to be outside doing activities with other vaccinated people. And so that might push into places or companies using, you know, vaccination record cards or vaccination passports. And I think there is a little bit of concern over that, what that rollout looks like, if it's really piecemeal or more systematic. But I do see that moving forward in a lot of places.
Professor, in your mind, how much of these decisions are grounded in science and how much of it is ethics? Because I'm really struggling with it at the moment. I can't understand whether they're trying to manage behavior of the people who haven't been vaccinated, so telling people who have been vaccinated and limiting the things they can actually do. Has there been some kind of scientific breakthrough in the last week that has led the CDC to say, actually, you don't need a mask outdoors? Or have they just delayed this decision for other reasons?
I think that the science is pouring into the CDC. They have, you know, NIOSH and many of their scientists looking at the data on mask usage, both in the lab and in the population. Studies are coming in from across the globe, and people are doing meta-analyses on them to sort of better understand at a global picture what masking does and doesn't accomplish. So I do think the science is pushing forward, and they're being informed by it. Did something dramatic change in the last week? Probably not. What we're probably seeing is an increase in the vaccination rates, which is great, although it has slowed a bit. We're still seeing the numbers tick up in the U.S., and the CDC feeling more confident in their ability to say enough people have been vaccinated that these are the places we do feel confident in putting our stamp to say this is safe.
I guess does this get put through an ethical filter after that, Professor? Because it's clearly safe for someone who's vaccinated not to wear a mask outdoors, and it was safe last week, it was safe the week before, and they probably knew that it was safe a month ago. And I think at the moment, from my perspective, and forgive me for inserting my personal opinion, and you're the expert, so please push back. From my personal perspective, there seems to be a worry that if you tell me, who's been fully vaccinated, that I don't have to wear a mask outdoors, how do you effectively police that? Because I've not got a big sign on my forehead that says I've been vaccinated, and other people who haven't been vaccinated might go around doing the same thing. And I think this keeps coming back to trying to police behavior, that I don't quite trust the American public to make the right decision. They're not sitting there and saying, here's the science. And I just get a feeling that it's the science through an ethical filter, through behavioral policing. Do you get that sense too, Professor?
I think I get the sense that it's the science through a sort of policy, regulatory, you know, government filter where everything has to have the stamp of approval. There's a liability issue if they say the wrong thing. There's a public media component if they say the wrong thing. And so it creates these layers that create the lag that you're talking about. But then on top of that, yeah, I do think that there is this piece of like telling people this is the behavior we expect to see, and how do you actually implement that? So they want to make sure that the policies and the recommendations and the guidances are all strong and bounded in science. You know, a lot of it is because of what you're saying, where you can't actually police that. So you want to push the guidance forward so that people are able to actually implement and police themselves. But you know, what does that actually look like? I think we continue to be in a wait and see situation.
When we talk about the science of it all, I'm curious about the science of the Moderna and the Pfizer vaccines. There was recent statistics that came out that showed that 8% of individuals are foregoing that second shot for both the Moderna and the Pfizer vaccine. What is the scientific ramification? How much protection do people get from one shot versus two?
Yeah, we do know that that second shot is really important in that lasting protection and getting those numbers up into the 90s, which is what we saw in the studies, the percent efficacy. So we absolutely want people to get that second shot. I think anecdotally what we're hearing is people show up, they are offered a different shot than what they got the first time, or, you know, an appointment is canceled or moved around and they get fed up and they don't go back, or they've heard from the, you know, media coverage and from these sort of back and forth conversations about, do we actually need to have the second shot right away, or can we push it, which was happening early when shots were more scarce, that maybe they don't need it. And that's what we don't want to see. the shots are available. We want to make sure that people get that second shot, especially if they can get the second shot that matches that first shot. That's really important. And we want them to get it so that we get up to that level, you know, that high 90s coverage, which is so important. You do get coverage after that first shot, although we do see breakthrough between, you know, people getting infected between shots 1 and 2 or very early after shot 2. So we know that second shot is important.
Professor, it's always great to get some clarity and your perspective too. Lawrence Sauer there, Johns Hopkins Associate Professor of Emergency Medicine. There's a lot of frustration around this topic at the moment, Tom, and I don't think that frustration has gone anywhere after yesterday.
Well, let me ask you, John, because I think you've been really up on the transatlantic ballet. How far are we from vaccine passports? I mean, EU wants them, right?
I think many people in the EU want them, and many people in the United States do not. That's why it's so complex.
I usually have a passport right in here if I have to leave on the Gulf Stream quickly. Come on.
Once again, it's ethical decisions, Tom. This is coming down to ethics.
How hard is it to have a passport saying you've been vaccinated?
Coming up, Julian Emmanuel at BTIG from New York City, a controversial topic in this country. Equities up 4. This is Bloomberg.
Oh, I thought it was Lisa.
One of the interesting features about this illness is that if you look at it, the people who develop these long-haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, it means you probably mounted a very strong immune response, okay? And you recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, oh, you know, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
Particularly, you know, sort of technology landscape have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Okay, traders, I'm placing a stop on profit for euro. the price I'm going to sell. If the price change direction at 120.69. Okay, so if this pair will change, will start going up like it's starting right now, I am going to sell at 120.69. Okay, so stay safe. If you follow this trade, please do so. Please play stop on profit. Don't play hero. Don't try to think that, oh, see, it will go straight away up, but it might. We will have chance to sell at higher price. And right now, position closed at 120.69. We have 2 pips, and in our case, we have £200 in profit because every pip broker pays us for every pip £100. In your case, you can have already confirmation from your broker how much broker paid you for this trade. Let's move on. Let's look for another chance, for another opportunity to trade pairs. I'll speak to you later, guys. Stay safe.
Thought they were de-emphasizing forecast-based monetary policy. Will they really wait for June?
No, come on, Peter
Hooper.
Hooper started the show, Deutsche Bank, and all you need to know is they're raising it up, John. This boom economy, they're raising it up, and the question is, how far out do you extend that? The forecasts are a mystery.
We'll catch up with Torsten Slok a little bit later this morning. Looking forward to that. Lisa, the forecasts are a mystery. Had a couple of companies in the last couple of days not offering guidance for this year. Last year it's because the economy was so bad, and this year it's because what? The economy is so good?
The real question to me is on inflation, and this really remains one of the key distinguishing features between a lot of investors. Jeff Gundlach of Double Line yesterday saying on Bloomberg BNN, he thinks that a lot of these inflationary pressures do not look transitory. I'm curious whether Fed Chair Jay Powell gives any guidance as to how they will calibrate transitory versus a more substantial wave of inflation, because they might not look at forecasts, but the rest of Wall Street does, and they're going to do it for them, and they're starting to get ahead of them.
Transport costs, raw materials, something that has come up in these earnings calls repeatedly over the last couple of weeks. Here's the price action this Wednesday. We look like this on the S&P 500. Equity futures slightly positive on the S&P. We climb higher by 3-4 points, up almost 0.1%. We have had a lift in Treasury yields over the last couple of days. Yesterday, a push higher through 160. Yields up again by 2 basis points to 164. Tom, I do love you for the sound effects. Give me one more. Euro dollar 120, 69, down 0.2.
2-year yield is right up against the top of the range.
I'll talk about it right now. The 2-year yield, Tom, has lost its heartbeat over the last year. And if you look at a 5-year chart, and I'll bring that up a little bit later if you don't cut me off again, I'll actually get there and we can talk about it.
I already did the chart with Francine earlier.
For this Federal Reserve, whether the front end of that yield curve becomes unanchored before they're ready to let it go and talk about raising interest rates. Unanchored on better data. Unanchored maybe on higher inflation. And Tom, that hasn't happened yet.
It hasn't happened yet, but John, what is the catalyst for the markets to take over and tell the Fed what to do? I'm going to go all Marty Zweig on you. Don't fight the Fed.
Either the communication changes or the data changes. That's what it's going to come down to.
Yeah,
and right now, the Fed and the market seems to be on similar pages. That can change. I'm with you.
You're giving me 2 transitories. Give me a 3rd transitory.
I'm going to move on. I'm going to get to Lisa and get the day ahead.
I think there's been substantial progress made between you two.
Do you think?
Yes,
can we
perhaps.
call it that?
Let's look
Should we
at
start to
substantial
taper?
progress. You guys
we
are
raise
working
interest
together.
Rates.
Substantial progress is what I'm looking at. We're getting that FOMC rate decision at 2 o'clock, then at 2:30 p.m. Fed Chair Jay Powell will come out and give that press conference. I personally am very curious to hear what he has to say about substantial progress being made in the labor market. What will it take for them to start to talk about tapering? People expecting that later this year, possibly the discussion, not the actual tapering. A lot of questions, and they're towing a really fine line here, being a cheerleader for the economy while also indicating they're going to keep monetary policy ultra easy. After the bell, we are going to see Apple and we are going to see Facebook earnings. One thing, John, you were mentioning about the rally and this 5% very quiet rally. Even within big tech companies, the share prices have been wildly bifurcated. You've seen Apple shares up more than 9% so far this month. Facebook shares up 1.6%. People sort of looking at some of the regulatory pressure as well as ad spending pressures, and what is their ultimate growth engine? Where is it going to come from? These are going to be some of the questions that Facebook will face after the bell. And then at 9 p.m., Joe Biden will be presenting his American Families Plan to a joint session of Congress for the first time. Expect him to speak about this $1.8 trillion plan as a way to redistribute wealth, inject more fairness into the tax code. Again, John, we are being overwhelmed with plans. What will stick? What has staying power?
A race to get things done down in Washington, D.C. If you missed the first 60 minutes of this program and you tuned in, maybe on accident, maybe deliberately, and you were listening to Tom, you would think this morning was a quiet morning. It's not. This is not going to be a quiet day either. Julian Emanuel of BTIG says, quote, "It is no exaggeration to say that Wednesday could be the most important day for markets in 2021. Julian, it's usually journalists that try and sell stories talking like that. Why?
We're just looking at the facts of the news flow between hearing from the world's largest company by market cap, Fed Chair Powell, and President Biden, particularly in this environment where we're having such an intense debate about inflation and whether economic growth is really in the low sixes, as consensus states that it is, or really more like 8%. And whether the Fed will have to react to that. And of course, we're going to hear that we're going to have more spending and higher taxes tonight from President Biden.
Julian, you have participated like no one in this market. State the bull case right now. State the case on this most important day of 2021, why I should acquire shares this morning.
The bull case is obviously we know that economic and earnings growth continues to power the market ahead. Negative real yields puts people in stocks away from bonds. We don't know how long negative real yields will persist. We do think yields are going to rise, but we don't think it's going to get to a point where it's going to be restrictive for stocks for quite some time. But again, the other thing is the amount of liquidity that's out there. $4 trillion plus in money markets, savings rates near all-time highs. All of these augur well for the continuation of the bull market.
There is a question about inflation, inflationary pressures, and David Bailey was saying we are going to see margin pressures for a lot of companies. Yes, they could pass along some of the costs, but not all of them. Where are you factoring that into your investment thesis?
Well, there's no question, Lisa, that that is something that's building. And for us, what it causes is sort of a drill down into, it's not just at a sector level, it's really a stock by stock level. For example, we've heard a lot of commentary from some of the consumer staples companies this reporting season that they will be able to pass their costs along, or they're planning to. And we take them, at their word in terms of thinking that way. Those are the types of companies we want to own. Pricing power is paramount in this market.
Where do the industrials and the manufacturers in America fit into that story, Julian? Because they might have a tougher time.
That is definitely a mixed bag. Very idiosyncratic, John. In fact, part of that is just trying to figure out, with copper at $10,000 on the LME, are you going to be able to see the economic activity, to see the infrastructure build, which is why the wrangling in Washington is so important for the industrial sector.
And of course, a firm rule here at Surveillance, when the LME is directed, we always go to Mr. Farrell for the follow-up question.
Thanks for that, Tom. I really appreciate that. But the follow-up question's not on the London Metal Exchange. It's about the 1970s. Every time I mention that decade, Julian, we get hate mail. It's real. Tom said it a million times. Julian, do you really think there's a 1970s parallel here?
There could be, and it's one of those things where we would like policymakers to realize the potential for it, okay? I think part of the healthy aspect of the debate going on in Washington right now is that there is an element of both Democrats and Republicans that think that the spending proposals may be a tad too aggressive and that we have to do it in a more reasoned way. But again, the countervailing point to that is if we start raising taxes, that itself is also a self-fulfilling prophecy in an environment where corn prices are through the roof, lumber, plastics, avocados, you name it.
Avocados, that has been a big concern for Tom Keene and the entire Keene household. There is a question about what type of tax hikes have been already priced into equities. Julian, do you see it at all?
We feel that there is an element of the corporate tax rate rising, probably to the mid-20s. We don't think that capital gains taxes are fully priced. And frankly, when we look at it, we're getting defensive on large cap tech in here as a tactical trade, simply because those are where the majority of capital gains lie looking out the last 4 years. And I think it's a reason why you're seeing these selected reactions post earnings.
Interesting. Alphabet being one of those selected outcomes. Julian, good to catch up, sir. Always good to see you. Julian Emmanuel, BTIG Chief Equity and Derivative Strategy. Bringing up copper on the LME. On the LME, copper, 98.13. The high of the previous cycle, 10.160, Tom. So just off all-time highs on the copper on the London Metal Exchange, where we topped out at the end of that commodity super cycle going into the end of 2010, early 2011, 2012.
And John, I really want to mention that, I've done a lot of technical work here on the Bloomberg Commodity Index, which is actually pretty good math. And I guess you can sort of call bear market breakout on commodities, but I don't hear that from all that many of our commodity guests.
What I hear a lot of, Tom, and we've heard it much less so recently, is the supercycle story. Now, as you know well, being familiar with how the supercycle played out last time, I remember covering the bust and spending a lot of time talking to the miners in London who had brought on way too much capacity, invested too much money in digging too many holes. That's not the story this time around. And I think more broadly, will the higher demand be met with higher supply, Lisa? It's not as simple for a mining company, of course. You have to make those decisions well ahead of time. And I don't think they're going to commit to this in quite the same way they did in the previous cycle.
Which is exactly the reason why Jeff Curry and his compatriots at Goldman Sachs and at UBS are saying that there is a lot more room to run for this commodity cycle because of exactly that. There is more discipline on some of the miner sides as well as some of the shale and oil producers.
Copper just a little bit softer over on the London Metal Exchange. Coming up in the next hour, Dan Skelly, Morgan Stanley, Market Research and Strategy. Looking forward to that. Futures up 5 on the S&P. We advance a little more than 0.1%. Julian Emmanuel calling today what could be the most important day for markets of the year. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Tonight, President Biden will unveil a $1.8 trillion plan to expand educational opportunities and childcare for families that will be paid for in part by the largest tax hikes on wealthy Americans in decades. Amongst the legislation's provisions, pre-kindergarten and community college would be free and the child tax credit would be extended. Meanwhile, fund managers would lose their carried interest tax provision and the top tax rate for individuals would go back to 39.6%. Fed Chair Jerome Powell is expected to maintain aggressive support for the economy. Fed policymakers wrap up a two-day meeting today. They're all but certain to hold interest rates near zero. They're also expected to repeat a pledge to keep buying bonds at that current rate of $120 billion a month. 4 years of political brinkmanship have come to an end. European Union lawmakers gave their approval to the post-Brexit trade agreement with the UK. That ensures that commerce will continue without the chaotic disruption to business a no-deal Brexit once threatened. Still, it doesn't mean an end to hostilities between the two sides. And Deutsche Bank has posted its strongest quarter in 7 years, and it's raised its outlook. Fixed income traders outperformed most of their peers on Wall Street. Income from buying and selling debt securities rose 34%, and Deutsche Bank avoided losses from the collapse of Archegos Capital Management. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Talking about a tax change that would affect, again, the 0.3%, the top sliver of households. The principle here is to equalize the treatment of ordinary income and capital gains.
That's the objective. That was Brian Deese there, National Economic Council Director. You will hear a lot more on this when the President of the United States addresses Congress a little bit later this evening. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here is your price action as we count you down to the open in about 2 hours and about 12 minutes away. Equities advanced a little more than 1/10% on the S&P. The Nasdaq just a little bit softer, lighter, lower, down 8 on the Nasdaq 100. Yields are higher by a couple of basis points through 164 on 10s. Going into Chairman Powell's news conference a little bit later. Full coverage, team effort, special programming. Tom Keene leading that a little bit later this afternoon. 164 on 10s. Do you like that, Tom? Euro dollar 120.67. Thank you. Down 0.2%. A weaker euro, a stronger dollar on that currency pair.
The backdrop, John, for this, and we're going to get to Emily here in a moment on the taxes, is, John, we're really beginning to see Jobs Day in May 7. The surveys in Morgan Stanley, well out over 1 million jobs created. I mean, John, you wonder if we're going to see all those ramp up here as we go to May 7.
And again, and then we'll do it again and on repeat through the summer. Tom, that's what we need to see quickly. We want to see that unemployment rate come down to maybe a 4 handle by year end. And could we threaten a break below that? That's where the conversation will be in the months to come.
This sort of State of the Union tonight is a boom American economy. We really haven't seen that since the late 1940s. Emily Wilkins on the energy in the room tonight. Emily, what will you expect to see in the room? Are the Republicans going to sit on their hands? Yes. How many Democrats will sit on their hands?
I'm sure Democrats will be up and applauding. I mean, the sentiment throughout the Democratic caucus is that even if you're not on board with exactly everything that the president is proposing, you certainly want to show your support and show unity. But let's remember, it's going to look very different this time. There are only going to be about 200 people in the actual chamber. It's going to be a lot of spacing, a lot of gaps. So definitely a very different energy this year.
Well, okay, I'll take your point on that. And I believe we have just a Supreme Court justice, a Chief Justice attending for the same kind of idea. Emily, which tax do moderate Democrats care about?
I mean, at this point, the biggest push that we have actually seen is about that state and local cap that so many moderates in the House are pushing to have removed. They don't like it there. They're from New York. They're from New Jersey. It's really hurt their constituents. And they're saying that they won't pass a final package unless that SALT cap is removed. And at this point, you haven't seen President Biden touch that cap a lot. It does bring in revenue to the federal government. It does tax the wealthy. Those are both things the administration is looking for right now. But remember, the proposal that President Biden comes off with tonight, that's going to go into the House, and we've already heard from House lawmakers who say that they are going to be changing aspects of that proposal. Top appropriator, very powerful Representative Rosa DeLauro has said that child tax care credit, that's only going to be expanded for a couple years. She wants to make that permanent. Progressives in Congress told me the other week that they want to make sure that there's something in this package that deals with health care, that deals with the high cost of prescription drugs. So look, we are going to see President Biden's proposal come out tonight, but we're also aware that on both sides of the Democratic spectrum, from the moderates to progressives, they aren't 100% on board with this plan, and they want to make sure that changes occur as it goes through the legislative process.
Emily, Lisa has a lot of questions on that, so I'll keep this brief. Just the words of Brian Deese. The principle here is to equalize the treatment of ordinary income and capital gains. Now, they might be able to move closer to that goal. Can they actually achieve that goal?
That's a great question, Jonathan. And yeah, there are a number of Democrats who are sort of looking at that 39.6 number and saying that's a little bit high, but they're going to see how it plays out. You've already seen Senator Joe Manchin of West Virginia, one of the more moderate Democrats, and what some of us jokingly down here refer to as the actual majority leader in the Senate. You've already seen him say that he wants to see these taxes kept low. He's not really jiving with the high numbers that we're seeing from President Biden here.
He's also questioned, Emily, whether the high numbers really matter when it looks at the effective tax rate that companies actually pay. I mean, just looking back to when the tax rate was 35%, data shows that companies only paid 26 to 28%. They paid materially less throughout history based on different loopholes. What kind of discussion is there around what Joe Manchin has suggested, which is close the loopholes, try to make the tax code a little bit more concrete in terms of the actual taxes paid by corporations?
That's definitely a message that Senator Joe Manchin has right now, and it's one that a number of Democrats are listening to. I mean, if they raise these tax rates, it doesn't look good for a number of taxpayers. And then if they're not getting that revenue in, what was the point in the first place? So that's certainly something that Congress is going to continue to take a look at. It really does get into the sort of nuts and bolts. You heard Manchin say, you know, why is this? Why hasn't the federal government gotten as much as they should from these corporations? He's called for an investigation into that. There are other members of the Senate and House who are similarly interested. And I think that's one of those things that we're going to see worked out through legislation. It's just a matter of Congress sort of getting in there, getting into the nuts and bolts of what the president's proposing tonight.
Emily, what's the main opposition to closing these loopholes? Why haven't we heard more on this?
I mean, I think that there's always that difficulty when it comes to lobbying groups. There are a lot of lobbying groups out there representing a lot of corporations, and they want to keep some of these loopholes in place. And for lawmakers, it's important to remember what these corporations want to a certain extent, either because they have jobs in their district or because they have these big donations to lawmakers. I mean, Capitol Hill has a lot of people pushing for a lot of different things, and some of these smaller loopholes that you know aren't going to play well with voters, it's very easy to say, okay, whatever, we'll keep it in there. I don't think the folks back home who vote for me are going to realize one way or another.
Emily, thank you. It's good to see you. Emily Wilkins, Bloomberg Government Report on the latest down in DC. Let me bring you the latest in London, if you'll indulge me just for a minute. We talked about a headline in the previous hour. The Prime Minister facing a formal probe over the refurbishment of his apartment at Downing Street. The Prime Minister responding to those allegations. Speaking in Parliament, I paid for the Downing Street refit personally. I will take advice if funding declarations are needed. I have confirmed in full with the ministerial code. People will think it's bizarre to focus on the flat. I have no doubt that people listening right now share that right now. People will think the refit is irrelevant, the Prime Minister goes on to say. He also says, Tom, no laws have been broken over the flat at Downing Street, and he looks forward to the verdict from the Electoral Commission.
Yeah, absolutely. George Osborne emails in on Osborne and Little and suggests, you know, the collection of decorative prints and velvet embroideries offers a modern take on the quintessential English country house. I mean, nothing says 10 Downing Street like Osborne and Little.
The Prime Minister, Lisa, fired up in Prime Minister's Questions over in Westminster, London at the moment. I'm getting reports of that he appears a little bit rattled over all of this.
I'm sure this is not the narrative he really wants right now. He's got to drag this economy out of a really bad recession. He wants to celebrate some of the vaccination efforts, and instead he's talking about the curtains.
The curtains and the flat, and unfortunately so are we on a day where the President addresses Congress a little bit later. The Federal Reserve Chairman delivers a news conference, and we get earnings from one of the most important listed companies on the planet.
But the flat.
Apple, but the flat in Downing Street. We'll talk more on that a little bit later.
You know, they went with you remember the color code from like 20 years ago, Walmart Blue?
You started this, didn't you?
Walmart Blue, really?
You wanted to go there.
Yeah, you know,
you wanted to go there. Futures on the S&P up 5, on the S&P 500.
He bought Faro and ball paint.
You reckon?
For the labor
I think you're probably right, Tom. I mean, just a guess.
The complete Faro and ball.
Yields up
French
2 basis points. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
From New York City for our audience worldwide, live on TV and radio, I promise you we will not talk about a flat in Downing Street for the next 10 minutes or so. Equity futures up 4 on the S&P. We advance 0.1%. Doing okay on the Nasdaq, slightly negative. Alphabet, the one to watch, flying up more than 5% in a pre-market. Katie Lyons will run you through the stock movers in just a moment. Talk about a name leveraged to the reopening trade. This in big tech, a $1.5 trillion tech company. That's where the boom is. Switch up the board and get to the bond market. 2s, 10s, 30s. Yields have been pushing higher over the last day. Up through 160 yesterday, up again this morning by a couple of basis points to about 164 on 10s. On 30s, we advanced to about 230, 231. But it's the front end of the yield curve that I think we need to discuss just a little bit more. Tom, I did this for you. I know you're absolutely captivated by it. A 5-year chart of a 2-year yield. Switch up the board. It looks like this. For our audience on radio, it goes up, then it rolls over, and then it loses its heartbeat for the next 12 months or so. And somewhere down there is some price action in the bottom right corner of the chart. Your 2-year yield right now is 0.1759%. The Fed is the elephant at the front end of the yield curve, and right now the market's playing ball. What's going to be interesting for me in the next few months, few quarters, maybe into next year as well, Tom, at some point when the data is surprising to the upside, people start to recalibrate what the Federal Reserve is going to do, and that yield starts to get a heartbeat again, and things start to get a lift. Hasn't happened yet, but that's going to be the one to watch.
Then a recalibration of that will be a process or an event, and we will have to see in terms of market stability.
Do you like that, Tom? How we just got along, you know, I teed you up, you said something back, didn't cut me off. It's truly original.
Great on radio.
Thank you. I appreciate that, and so does our radio audience. Almost 18 basis points on a 2-year yield. Katie Lyons can't wait for this. Romain Bostic, I don't know where Romain is, but Katie, good luck.
Yeah, Romain isn't here for the love fest between you and Tom today, apparently. But, John, you mentioned that Alphabet is flying in pre-market trading. That is absolutely true. The stock is higher by more than 5%. Blew past expectations when it comes to revenue in the first quarter. You can thank Google's ad business. As the economy reopens, businesses are ramping up their digital advertising spending, trying to attract those consumers. Also, $50 billion share buyback. That's not hurting the stock this morning either. I would note Facebook hasn't reported yet. That is due after the bell today. But those better ad trends from Google are lifting sentiment for that stock as well. It's higher by about 2%. You do have Microsoft moving to the downside, though. Forget record quarterly revenue. Forget the 9th in a row beat on earnings. That is just not good enough in this earnings season, given how high expectations were. That stock is lower by 2%. But getting absolutely pummeled in pre-market trading is Pinterest. It's not the first quarter. That wasn't the problem. They beat expectations. It is the outlook. That pulling forward of demand that we saw with Netflix is true for Pinterest too, Tom.
You know, I'm so glad you put Pinterest in there. John Farrell, I mean, if Pinterest split, it would be a Dow component.
But Kaylee brings up such a good point, because pull forward and payback for pull forward is something we saw in Netflix. We saw it with Pinterest. But for other tech companies, we're not seeing it, Kaylee.
Yeah,
for other tech companies in the cloud business, we continue to see that acceleration.
Cloud definitely doing strong, but this will be interesting for Facebook too come those earnings after the bell, John, because maybe ad business doing quite well, but will their user growth be flat like we're hearing from Pinterest in the current quarter? That is something I will be watching. Those shares are down for Pinterest, 11.7% in pre-market trading. We have a number of other earnings movers to keep track of as well. One moving to the upside is AMD, the chip maker. Bullish outlook for the second quarter and raised its 2020 guidance. That stock is up 5%, but another chip stock, Texas Instruments, just had an inline forecast for the second quarter. Again, not good enough this earnings season. That share, those shares down 3%. Starbucks also a little lower. Global comp sales growth just 15%. Analysts were looking for more like 17%. I would note U.S. comp sales growth did beat expectations, and I wonder if people were out at Starbucks using their Visa debit cards to buy their coffee, because Visa saw debit card volume in the U.S. up 31%, Tom. 31% as those stimulus checks hit Americans' bank accounts.
I go in there and get a small black coffee.
I'm a tea drinker myself.
I mean, Lisa, help us here. Are you in there getting the mocha Cachito?
The mocha
Machito.
Mocha Machito. Oh, yeah. I've got the special Mocha Machito. No, I drink the Bloomberg special.
What's the Bloomberg special?
It depends on the day, and it depends when the Tom's
just
making
what you get brought.
Depends on the floor, too.
Sauce.
I am caffeine-free, as you all know.
I'm not.
Caffeine-free.
That explains
decaffeinated.
3 cups of
what
coffee.
What does that explain, TK? Indulge me. Come on, tell me.
Kaylee, help me here. Say transitory.
Kaylee, you are allowed to leave.
Can I go now?
Yeah,
you can.
go ahead.
Kaylee Lyons,
it's
thank
been
you.
a transitory experience. Kaylee Lyons, thank you so much for humor.
Just quickly, Satya Nadella of Microsoft with the lead quote in that press release yesterday. Tom, listen to this. Over a year into the pandemic, digital adoption curves aren't slowing down. They're accelerating, and it's just the beginning. That's your lead quote. Can you get any more bullish than that?
Yeah, I think that's a structural change, and that's sort of the issue here. And of course, part of that, John, is a structural market. Dean Kernan nailed the structural change in volatility. We were 22, 23, 24, and he said, wait, we'll get back to some form of norm at 17 or 18, and we are there. We get an update from Mr. Kernan with Macro Risk Advisors. Dean Kernan, how do we get back to what we remember, 12 or 13 on the VIX?
Yeah, you know, it's time. It's fascinating to look at these cycles, and if you think about, go all the way back to the pre-global financial crisis period, we had a VIX that printed below 10 in late 2006, early 2007. We got to 80 by November 2008, and by December of 2017, we were back at 9, only to hit 80 in March of 2020. So these cycles are long. And it's an eventuality, but as you noted, Tom, we've basically had the call that the pandemic destroyed the risk-bearing capital that was effectively allowed to sell options. And so you had a supply shock, and you also had a demand shock. The retail demand for short-dated options was just insatiable. And both of those are starting to sort of reverse, and they're allowing the VIX to settle in. So I don't see 13 or 14. But I do think, 16 or 17 is, I think we'll hang out here for a bit, absent some shock.
Dean Kernan, we mere mortals look at the VIX as a spot price, the present price. What do the future estimates of the VIX tell us?
It's I would say a reasonably normal curve at this point. So typically you have the VIX settling in at a lower level versus 1 month, 2 month, 3 month VIX futures. It's a little bit of a function of supply demand, but it's also a function of very low realized volatility right now. I think something that's fascinating, and you're seeing it in declining volumes. The market's in a little bit of a holding pattern right now. 1 month realized volatility on the S&P is threatening to go below 10. And then jointly, and this would be the first time this would happen post-pandemic, 1 month realized volatility on the TLT at the same time is almost below 10. And that interaction, that combination of volatility in the stock market and the bond market, and then you overlay the correlation of these two, it's actually pretty market friendly right now. So we've got this period where the market's not forcing you to do anything. And what I see in clients who often talk about hedging is they're just not feeling the urgency right now to hedge because the market's not forcing that urgency. And, you'd rather sort of save your premium for a bit of a rainy day. And so I think the the challenge for us right now as analysts is to really think about what that set of circumstances is that would catalyze volatility. I don't see it happening right now. I see some problems towards the end of the year, and a lot of it comes back to the conversations you guys are having, which is it transitory, is it not? Is the Fed's kind of catch up and wait strategy an accident in the making?
Yeah.
I'm worried about the end of the year in terms of the Fed and inflation.
By the way, Dean, I do see Tom Keene taking a drink after you said transitory, so very much on cue. There is a question, though, about what you're talking about. It's very market friendly. Another way to consolidate what you're saying is it doesn't pay to be bearish or in any way to hedge just being pure risk on. And there is a question of whether all the liquidity in markets have killed off measures of risk in markets. What are you looking for? I mean, are these going to be the first indicators, higher VIX readings, that there is some danger percolating underneath?
Yeah, it's a great point. And boy, I do think the Fed, one of the side effects here of all this policy is the sort of the pricing mechanisms that we rely on are certainly distorted and don't give us the same clean signals. I think you can look at something, Lisa, as basic as realized volatility, and that's just simply the day-to-day changes in the S&P. What's the magnitude of them? And I mentioned we're going below 10 in realized volatility. That's basically saying the S&P is moving kind of 0.5%, maybe 60, 70 basis points a day. That's just not enough. So I think that's one. It tends to be the case that market vol events don't just happen out of nowhere. They tend to build. So what we'll have to see is more frequency of 1.5% moves. That'll move the VIX back up to a little past 20. I think we're supposed to as well, of course, watch the 10-year. We've gotten to this period where we hit a holding pattern. We settled in at 160-ish. And as John was referring to before, the action has really not been so much in 10s. It's not that much in 2s. It's really more in the 5-year part of the curve. And I think...
What's he doing, auditioning for the real yield?
Carry on, Dean.
I would love to be on. No, I think, looking at, for example, something like the 2s-5 spread, I think there's a tremendous amount of information there. And again, the markets effectively said, look, the Fed's promises are still good roughly out to 2023. Past that, we start to get worried. So if you start to see the 2-year sell-off, that's the market effectively really pressing the Fed.
Dean, before you go, received a note from you about a month ago, and I think we're all urging you to get better. And for people who don't know what I'm talking about, Dean, I know you were in a pretty serious accident, jet ski accident, a couple of months back with the family, your 2 sons. Dean, can you update us on that? In your words, my personal VIX hit an all-time high. How are you feeling now?
Yeah, I'm doing a lot better. We did have an accident on a vacation. I'll tell you one thing. So the concept of the PVIX is, we all go through struggles, and one of the things you realize when you're on your back is the amount of help that people are willing to give in the healthcare industry or just generally is tremendous. So thanks to my incredible nurse, my wife, Frances, I'm back on my feet, almost, and back in New York. And, really looking forward to the progress from here. And thank goodness my kids are okay as well.
And, Dean, looking forward to giving back as well. You do a lot of work with a charity called Macro Minds, and I'd like to give that a shout-out right now, Dean, because I'm looking forward to working alongside you in the coming month. Here's a line from you. Kids whose parents went to college are 7 times more likely to go to college themselves. Dean, what can we do about that?
It's tough. I think it's a kind of pick up a shovel and get in motion. Obviously the government's trying to do a lot, but I think it starts from the ground up, and it's just really trying to make an impact locally. I do think that unfortunately, the education shortfall has always been more of a systemic, self-reinforcing idea, but the pandemic has made it just so much more difficult. I mean, I think as parents, we've all seen our kids struggle through Zoom and class every other day. If you started with less, it's just that much more difficult.
Dean,
so just trying to push back on that.
Recovering and giving back. You're a good man, and too many people on Wall Street get a bad rap. Dean Kernett, Macro Risk Advisors CEO from New York City. This is Bloomberg.
With the First Word News, I'm Ruchika Gupta. President Biden goes before a joint session of Congress tonight to try to sell his historic spending plan. The president wants money for childcare, universal pre-kindergarten, and tuition-free community college. He plans to pay for it with tax hikes aimed at high-income earners. Republicans already have announced their opposition, and some progressives are calling on the president to do more. President Biden's plan would do away with private equity's most lucrative tax break. Fund managers rely especially on a share of the appreciation in the assets they oversee. That's known as carried interest. Those profits have been taxed as capital gains. That tax break would go away under the president's plan. He also wants to raise the top rate on capital gains. Saudi Arabia is in talks to sell a 1% stake in Saudi Aramco to what's described as a leading global energy company. The sale could be worth about $19 billion. According to Crown Prince Mohammed bin Salman, the kingdom is looking at a deal as a way to lock in customer demand for the country's oil. Investors weren't satisfied with Microsoft's quarterly report. Sales and profit beat estimates for the 9th time in a row, boosted by rising demand for cloud computing services, but shares lower pre-market. Some analysts say recent gains in Microsoft stock had led to swollen expectations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
Right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, the party, makeup will bounce back.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Apple's a company that's been a master of supply chain over the years and has continued to look for ways to diversify supply chain. As best we can tell, demand remains robust across product lines and across geographies. We're again expecting 20% plus growth across, really all the product lines as we move into this quarter.
Apple reporting after the close later today. Will Power, their Baird senior research analyst from New York City this morning. Good morning. Alongside Lisa Bravitz, Tom Keene, I'm Jonathan Ferro. Here's your equity market price action this Wednesday morning. On the S&P 500, equity futures going absolutely nowhere. Yields higher by a single basis point on a 10-year to 163.42. Euro dollar negative by a little more than 0.1%, 120.73, and crude positive, $63 and about 56 cents. We advance a single percentage point almost, Tom, going into the Fed a little bit later this afternoon.
An important conversation, John, and what we try to do at Bloomberg Surveillance is to do earnings and do corporate analysis differently. We spend a lot of time on the financials and less on the product. Amit Daryanani at Evercore ISI is truly one of the Uber bulls on the street. His price target, to get your attention this morning, is up 30%. Amit, thank you so much for joining us. How do you get to such a bullish stance? Is it about their ability to persist in creating free cash flow?
Yeah, thanks for having me. Fundamentally, yes. Our take on Apple has always been, this at the end of the day is much closer to a consumer staple company like a Coke or a Pepsi or a Procter & Gamble or a luxury goods company for that matter. And if you look at those assets, consumer staple luxury goods, those assets tend to trade in a 27 to 30 times free cash flow multiple versus Apple that trades around 21 times today. And so our price target is really driven by the fact that we think that valuation gap will close as people appreciate the fact that Apple is less of a hardware tech company, more of a consumer staple company.
I mean, what do your conversations with the buy side sound like right now?
I think at this point, investors are kind of caught in between two dynamics, if you may. The near-term stuff is numbers are poised to be very good in the near term. Estimates should be really good for March and June. The flip side of that, the longer-term concern, I think, has become as you get into the back half of the year, really September and then December, compares start to get difficult. And that's, I think, the angst investors have, which is how can the stock keep working when the compares start to get difficult in the next, call it, 9 months.
In addition to that, Amit, it's the margin story. If you get the product mix shifting, as you point out, away from the iPhone, do the margins hold up? Do they?
They should, right? If you look at the services gross margins, they tend to run very consistently in the high 60s kind of range. Product is in the low 30s. So to the extent you believe the narrative is about monetization of the install base, which we think it is, then gross margins should steadily keep walking higher, which also means free cash flow should steadily keep improving for them.
There was a time when people were looking to services as a potential ongoing cash stream for Apple, especially if they do not come out with new revolutionary products. Has that narrative shifted, Amit?
So I think services continues to surprise folks, right, in terms of the growth it's had. So I think the faith in services doing 20% growth has been there. I do think the incremental part that's come out in the last 2 years is an appreciation that the wearables business, which is another $40 billion revenue stream that they're on track to have, is going to keep doing well. So I think you've had a little bit of diversity of the monetization install base. It's services plus it's wearables as you go forward. And I would say that there's incremental excitement, cautious excitement on new products, especially around Apple Car and AR/VR headset that you could see in the next couple of years from Apple.
In the meantime, though, they are struggling with the supply chain disruptions that a lot of companies have been. Are you expecting them to detail at all the steps that they're taking, perhaps giving more details around that $430 billion spending plan in the United States to try to shore up their supply chain?
To your point, everyone that has reported so far has talked about some of the problems with the supply chain and component availability, logistics costs, and so on. Apple is not going to be a whole lot of different. The only part I would kind of point out and say is, listen, Apple is typically the biggest customer any semiconductor company has. They procure between 8 to 14% of semiconductors components in a given year. So they are big, which means they will get more than their fair share of allocation. So I'd be surprised if Apple gets on a call and says, we couldn't hit delivery schedules because we didn't have product. I think they'll be fine from that front. I do think they'll talk a lot about what the investments in North America mean, what supply chain diversity for them over time will mean. So I do think they'll talk about all that, but I do think their scale will provide and shield them from some of the issues we've heard from other companies.
Tell me about the price target. You're way out in front of the street. How far behind is the street from where you are, Amit?
Oh boy, listen, I think the street tends to focus on iPhone cycles, hyper-focus on iPhone cycles, I would argue, and less appreciate sometimes the monetization narrative that Apple really has, which means people get exceptionally bullish when you are going through a good iPhone cycle like the iPhone 12, and they get somewhat more tepid after you go past that, right? And I do think that's the wall of worry people have to go through. I think in our stats, our take is this is not about iPhone cycles, this is about monetization over time.
Amit, we've got to leave it there. Always great to catch up with you, sir. Amit Daryanani, Evercore ISI Senior Managing Director, and together with Dan Ives, the most bullish on the street. 175, the price target over at Evercore. Likewise at Wedbush, the medium price target over the next 12 months, 151. Of the analyst community, Tom, 32 buys, 9 holds, 3 sells.
Well, this is an important thing. I take these price targets very seriously because it's really what these guys are compensated on. And I would note Tyler Radke moments ago to $310 on Microsoft. So Citigroup, John, has a 20% plus a 22% lift in Microsoft to their price target, as we saw Amit with a 30% plus lift at Apple.
Shall I repeat that line from Satya Nadella of Microsoft? Over a year into the pandemic, digital adoption curves aren't slowing down, they're accelerating, and it's just the beginning. Lisa, that is a bullish line in that press release.
And it's borne out by reality. I mean, look, even if people go back to the office, listen, how about kids that have been home for the past year working remotely? You think they're going to give up their newfound love of screens and their newfound permissive by their parents who are absolutely looking for anything to occupy them?
Why are you looking at me like
I'm
that,
just
Lisa?
saying,
you're
theoretically.
Lisa, you're looking at me. I see you looking at me.
I'm just saying.
Tom feels seen.
It's not just you. It's literally every parent out there. And the kids reshaping their feeling for screens, that goes to a bigger bill, and Apple reaps the benefit.
What do you make of these return-to-work plans, Lisa, from the various banks? They're slowly starting to drip out ahead of the summer.
The bifurcation between the U.S. and European banks, I find fascinating. U.S. banks saying get back to the office, we expect you here. European banks saying work from home is the new reality and we're cutting office space.
Do you know what I love about that? Yes, it's the last bit. We're going to do this for you. Oh, and we're going to cut the office space.
Well,
in other words, the European banks have seen a gap here to cut costs. But we're doing this for you.
Yes.
Of course.
Where do you think we're going to be in a year? Seriously, where are we going to be in a year?
I don't know. I think we're going to be more surprised by how quickly things go back to normal.
I would
agree. By how much has changed.
I am in that camp.
I would agree as well.
Dan Skelly, Morgan Stanley, Head of Equity Model Portfolios, as I take a couple of minutes just to digest and process the fact that we all agreed on something. So maybe we're definitely wrong. This is Bloomberg.
Let's agree on that.
is odor detection. And this is because no matter how you're bound, what container you're in, you're still producing and releasing odors. And we're kind of building off of wildlife detection dogs.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center,
to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Wednesday, the Fed decides. The Fed is on hold waiting on inflation. But for how long? Coverage begins 2 p.m. on Bloomberg Television.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
As things normalize, you're going to see a shift back towards services, and that means taking some of the pressure off the goods sector.
The amount of liquidity that's out there, $4 trillion plus in money markets, savings rates near all-time highs, all of these augur well for the continuation of the bull market.
We know this economic data is great. This is all reopening, fiscal stimulus. Well, how much does behavior change? We're all becoming behavioral scientists.
There will be, I think, temporary inflation for the course of the next 12 to 18 months.
The good news is long-term, big picture, the Fed has a long track record of controlling inflation, but it could come at a cost.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Julian Emanuel calls it the most important day of 2021. We are thrilled you're with us for the conversation at hand. And John, what we heard there in the opening montage was the optimism of the haves. President Biden tonight is going to talk about the rest of America.
An address and a $1.8 trillion aid plan for families in America, the United States of America, and a big change down in Washington, D.C. But as Lisa has repeated through the morning, again and again and again, this is a lot of multi-trillion-dollar plans piling up, Tom. Their proposals, can they be executed? Can they be passed?
The polarity here is absolutely remarkable. We talk about boom Microsoft, boom Google, boom Apple. And yes, the markets, John, you've mentioned the shock of where we are in late April versus the beginning of the year. And yet the rest of America really has a labor struggle.
We're up more than 5% on the S&P 500. We've hardly talked about it. We're up more than 30% on Alphabet year to date. We've hardly talked about it. There is a cyclical story embedded in big tech. We've hardly talked about it, and you saw that in the Alphabet numbers. But that's the story. Main Street versus Wall Street. Wall Street's had a great 12 months. Now the conversation shifts to Main Street and what's going to happen with labor costs. What's going to happen with the costs elsewhere, inflation, raw materials, transportation. That's where things get interesting for me from a market's perspective. How do you get exposure, leverage, the reopening, and a cyclical upturn with all of this going on around you?
All of this going around you, this most important day of the year. We welcome you on radio and TV, right through to David Weston tonight in the President's Address. And Lisa Abramowitz, what is so important here is not so much the politics of Washington, but how you get Main Street back and link with Wall Street.
And that's what a lot of people are focusing now, and people are saying that for a long time, markets outperformed Main Street, outperformed the fundamental economy, and perhaps we're shifting into a period of time where it'll be the opposite. And we've heard that from a number of people. Yet, what does that look like when you see the profits that we're seeing out of the likes of Microsoft, out of the likes of Alphabet?
Now, it's going to be interesting to see. John, I want to go to the data. Instead of doing a full data check, a little bit of red on the screen, dead in the water, we do have a modest lift in yields. Why, John?
Through 160. We talked about the auction through the week. A couple of tricky ones so far on the supply side of the story. Going into the Fed, yields get a lift. We're through 160. Right now, we're up another basis point to 163.60. I just can't believe how little we've talked about the Federal Reserve over the last 2 hours on this program.
Well,
we have a Fed decision and Sherman Powell news conference.
Let's go to the why of that right now as we go to 2 p.m. this afternoon with a great lineup of guests. John, are we just waiting for June?
Message received. Message received. Everybody seems to understand the message from the Federal Reserve. And yes, I think we're waiting for June when we get a new set of forecasts. And what's fascinating about that is we often wait for a new set of forecasts. But this is a Federal Reserve telling you they're no longer dependent on the forecast. So why are we waiting for the June meeting at a new set of forecasts?
I will have to see, but what I like there is the view forward, John, and how you partition this on radio and TV. We've had a lot of different conversations, many of them optimistic, and Daniel Skelly joins us now with Morgan Stanley Wealth Management, their head of market research and strategy. And Dan, I really want to cut to your beautiful note where you say you need courage to look out 2 to 3 years. How do I get from the panic of 2021 and look out to 2024 or 5?
Yeah, that's really interesting viewpoint today, Tom, because when you think about it, Morgan Stanley is trying to distinguish between its long-term view, 2 to 3 years out, and its short-term view. And as you know, we're a little tactically cautious here in the short term, given how far markets have moved and given we may be lapsing some of these peak rate of change on earnings and policy, et cetera. But to your point, when I look out 2 to 3 years, I'm extremely optimistic. There are several mega trends here that will probably make this cycle hotter for the next several years, including a very powerful consumer rebound that goes on, talking about pent-up demand for services, including digital investments, which is really one of the main takeaways from the COVID experience. It was a massive digital wake-up call. So we're going to see investment in technology through many sectors. That's going to be a boom to the economy going out. And then lastly, it's all about demographics. We're actually going into a bullish time in terms of demographic shifts where the millennials, who are now a bigger part of the population than the boomers, are reaching their peak earnings in investing years, and that's going to drive flows.
Dan, let's pick up on a couple of pieces. The first one, peak rate of change. This cycle is so unique and so different that we're seeing peak rate of change right at the beginning of the recovery. Just because of the nature of the slowdown, it was mandated reopening, mechanical pop back. Why is rate of change so important still, given how unique this cycle is?
Yeah, so everything is happening just faster, Jonathan, to your point. And so looking back at previous cycles, this recovery is happening twice as fast, to your point. And so that's certainly running up against some headwinds now in terms of earnings rate of change. When I look at just earnings season thus far, and we heard a mixed bag overnight, some reported above expectations, some below. When I look at earnings thus far, we're halfway through. Over 80% of companies have reported beats, and yet the average stock reaction on the day of report is down 20 basis points. So why is it important? It's important because we're up 80% off the March 23, 2020 lows, and it simply means that we could be due for a little bit of a pause here. It doesn't mean we're diverging from the longer-term bull market, to be clear.
There's an issue that you and Mike Wilson and the team have brought up repeatedly, and that's execution risk on the cost side. Labor markets, tightening up maybe, harder to hire, harder to meet that demand with supply. Yesterday, what we saw from big tech was a cyclical story embedded in those big names that we haven't discussed enough. Dan, is that going to be the cleaner way to leverage the cyclical trade without the worries about higher costs?
Yeah, that is an interesting way of looking at it, Jonathan. We are certainly actively looking at tech and being selective in some of the growth space. And as we've talked about in the past, we're going to do more outside our houses finally this year, but we're never going back to 2019. And you're already hearing big financial companies talk about hybrid models, how much time they allocate in the office, and what that's going to do, frankly, for the demand for cloud, digital services. So, kind of looping back to your original question, we see these trends going on for several years. There is some cyclicality embedded, particularly in the advertising leverage names. And that's what you saw, over the last 24 hours. And so we do think that's a opportunistic thing to play.
On the flip side, do you think that the underperformance of the Russell 2000, of the classic small caps, which has been the traditional cyclical play, that underperformance will continue?
We do, and we saw, Mike Wilson, our strategist, downgrade small caps going back over a month ago, a well-timed move after being quite bullish for a year. And to Jonathan's point earlier, small caps, smaller companies are one of the areas that really acutely feel the cost pressures. and have limited ways of offsetting those cost pressures. So yes, we do see small caps continuing to struggle here near term as things adjust. And we want to also, in the overall equity portfolio, move up to quality and focus on those companies that have pricing power and are going to be able to pass on those costs to customers.
When you talk about cost pressures and you talk about a hot cycle over the next 2 years, yes, perhaps shorter than past, but still very hot relative to what we have seen, does that cohere with an inflation break-even rate right now that I'm looking at over the next 2 years of 2.66%, over 5 to 10 years of 2.3%? These are not astronomical figures, albeit some of the highest levels that we've seen in years.
Yeah, absolutely. And I think that's a function of just the complacency and a little bit of the lull that has set in for investors following the last cycle. I think there's some key differences between this cycle and last. I think you're going to see that manifested in the labor markets. We're seeing drastic labor supply shortages. You're going to see that play out in geopolitics, which has certainly diverged since 2008, 2009. And you're seeing the ramifications of some political and trade dynamics in chips and technology. That's causing inflation in certain areas. And so things are different. I think the biggest takeaway, really, why this time is different and why that number might be too low is fiscal, right? And you're going to hear more tonight, as we've talked about potentially more spending. We'll see if there's the math and the support for that in the Congress later on. But nonetheless, we see fiscal leading to higher inflation.
Daniel Scully, out 2 to 3 years, have you seen use of cash change? Do you see a corporate behavior that actually changed use of cash? I don't see it with Google.
Yeah, that's true. You're seeing more of the buyback trend that had defined the last cycle. Let's see what happens with capital gains and taxes, Tom. You know, what happens with the treatment of dividends? Do dividends become a more attractive source of capital return going forward if they're somewhat more insulated in terms of the capital gains tax issues? So, you know, I tend to agree with you. I think some of these really big companies have tremendous cash hoards, and we're going to hear more from the banks, frankly, later this year. As they continue to see reserve releases and earnings improve, they're going to be buying back more stock. So I think it's a combination of a lot of the things we've been seeing.
Dan is going to catch up. Dan Skelly, Morgan Stanley Wealth Management Head of Market Research and Strategy. Tom, use of cash, a $50 billion buyback over at Alphabet and tons more over at Apple over the last decade.
Yeah, I just did, John, and you can do this on the Bloomberg, folks. We have this huge advantage, we feel, within financial TV worldwide and radio worldwide, and that we're all working on the Bloomberg while we're talking here. John, if Apple got back to where they were on their balance sheet of cash, they need to find how to spend $25 billion fast.
And I think they know the best way of doing that, don't they? Because we've seen that repeatedly over the last several years.
That's a huge number. That's an unimaginable number. They need to figure out a delta of $25 billion today to figure out how to get back to a comfortable cash rate.
Do you want another big number from Morgan Stanley? 1.25 million. That's the estimate for payrolls. You brought up payrolls a little bit earlier, May 7th. Payrolls, 1.25 million is their estimate. Right now, the median, 900K.
And Lisa, I think this is so important. We're going out to Michael Feroli's. We're going to find 7 million employed here through the summer.
Is this substantial progress? Does this count for Jay Powell? Will he address that?
We'll find out with special coverage a little bit later on TV and radio. You're staying late today, TK. Looking forward to the show. Equity futures, 41.79. Unchanged on the S&P.
He's speechless.
He's so upset now. You got a late afternoon, Tom. I'm looking forward to the show. I really am.
What about the surveillance nap?
You can take it in the pantry. Futures unchanged. Isaac Boltanski coming up next. This is Bloomberg.
With the First Word News, I'm Ruchika Gupta. Tonight, President Biden will unveil a $1.8 trillion plan to expand educational opportunities and childcare for families. It will be paid for in part by the largest tax hikes on wealthy Americans in decades. Amongst the legislation's provisions, pre-kindergarten and community college would be free, and the child tax credit would be extended. Meanwhile, fund managers would lose their carried interest tax provision, and the top tax rate for individuals would go back to 39.6%. Fed Chair Jerome Powell is expected to maintain aggressive support for the economy. Fed policymakers wrap up a two-day meeting today. They're all but certain to hold interest rates near zero. They're also expected to repeat a pledge to keep buying bonds at the current pace of $120 billion per month. And Boeing burned more cash than expected in the first quarter, about $3.7 billion. The jet maker still recovering from the pandemic. In March, Boeing resumed deliveries of the 787, and it hopes to boost the 737 production in early 2022. Deutsche Bank is working on plans to allow staff to work from home up to 3 days a week. That would be one of the most flexible return to office policies amongst large international banks. Deutsche Bank has repeatedly said it wants to cut costs by reducing office space. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Part of the healthy aspect of the debate going on in Washington right now is that there is an element of both Democrats and Republicans that think that the spending proposals may be a tad too aggressive and that we have to do it in a more reasoned way. But again, the countervailing point to that is if we start raising taxes, that itself is also a self-fulfilling prophecy.
Julian Emmanuel, BTIG Chief Equity and Derivative Strategist, calling today possibly the most important day for markets in 2021. An address from the President of the United States in front of Congress, a Federal Reserve news conference later, and a proposal from the President for a $1.8 trillion family aid plan. Throw in some Apple earnings too. Here's the price action this Wednesday morning. Good morning to you all. Alongside Tom Keene, Lisa Abramowicz, Jonathan Ferro. Equities not even up by a point, up a quarter of 1 point on the S&P 500. In the bond market, yields up a single basis point to 163.42. Euro dollar negative to 120.68 and down 0.2%. The focus, without a doubt, on Cupertino, California, and Washington D.C.
Oh, it is. It's going to be on Apple. It's going to be interesting to see. And, you know, we saw it with Google yesterday. There's a lot of optimism here, a summary that maybe things will look up better, but the nuance will be in the call. Right now in Washington, Isaac Boltansky with us with Compass Point with a very sharp note. And I love the phrase, Isaac, from rhetoric to reality. The idea that we're loaded with rhetoric tonight. When does the reality click in? 11 p.m. tonight, or do we have to wait 11 weeks?
I would argue it's already starting to click in, and at least that's my takeaway from investor calls. You know, what we're going to get tonight, Tom, is an incredibly ambitious and expansive proposal that would, you know, intended to remake our economy in a way that we haven't seen since the Great Society under LBJ. But the reality is it's not going to happen. And one of my favorite lines, and the one that I think we should keep in mind as we listen to the president speak, is the president proposes, but Congress disposes. And really the question for investors remains, what will Congress agree to? And the subtext there is, what will the centrist Democrats in the Senate allow?
Okay, but I want to go out to your climb of Ohio Wesleyan University. I mean, they've got to sell this thing out where maybe the election is actually pretty close as well. How do the moderate Democrats around the acreage of Ohio Wesleyan adapt to their president and to their liberal wing?
I think that the main point there is that, and this is, I think, an important timing point to highlight, is that Infrastructure Week is going to last another 5 months or so, Tom. It's going to be iterative. It's going to be time-consuming. It will include myriad bruising fights over really detailed and nuanced policy issues, from like-kind exchanges all the way to stepped-up basis. It's going to take another, I think, 5 months, most likely until September or October, to get something done. But my view is that there is a window of both political and legislative opportunity that Democrats will seize on, and that we will get something. We're not going to get what the president calls for tonight, but we will get something of significance.
Isaac, given your experience in Washington, D.C., what is likely between the $2.3 trillion infrastructure spending, the $1.8 trillion American Families Plan? What's realistic?
Look, I think that right now we should focus on physical infrastructure. I think that that clearly has a considerable amount of support on Capitol Hill. I think there's actually bipartisan negotiation now, even though I wouldn't bet on that. I still think that we have to go through reconciliation. So I think we should focus on physical infrastructure. And then on the tax side, here's my framework. Anything that's seen as narrowing the gap between wealth and work has a likelihood of being included in the final package because it dovetails with the Democratic economic fairness agenda. So here I'm talking about the higher tax bracket, I'm talking about the increase in capital gains, and I'm talking about the end of stepped up basis.
Well, let's put some numbers on that. Equalizing the treatment of earnings and capital gains. The band is quite wide, the spread is quite wide right now. Isaac, how narrow do you expect the spread to get? What kind of numbers are you thinking about?
Yeah, look, I think that anything that we hear tonight should always be viewed as a negotiating marker, not a red line. And I think the White House has been clear about that. So we will not see a capital gains rate of 43%. I think that ultimately that will be negotiated down to something closer to the 28 to 30% range. I think there are a number of reasons for that. We have the centrist Democrats, but also I think there's an awareness that we want to incentivize long-term investing. Furthermore, there's an equilibrium where if you raise it too high, no one wants to sell. And so I really think it's fair to assume 28 to 30% on that end, again, for the highest earners.
Well, let me just add an additional question in then, Isaac, because what they're trying to achieve is to close that carried interest loophole as well. And from what I can tell, and you tell me if your interpretation is different, that they're trying to do that by equalizing the treatment of capital gains and wages, and the end outcome would be closing that loophole. Now, if they can't equalize that, can they just close the loophole by doing something else? And do you think they should do that?
Yeah, I think you hit the nail on the head. And it's highlighted in the fact sheet here. Their focus is really on capital income broadly. And so capital gains and dividends, by the way, were included. And if we just talked about increasing that threshold and ending stepped up basis, you really handle the carried interest issue in its own right. Now, I'm telling you, I don't think that they get all the way to treating as ordinary income. So there will be a focus on a more narrow fix to carried interest as well. I think this time Democrats are finally prepared to close that.
Did, because all this stuff is malleable and changes, and I avoid the nitty gritty as much as I can. It was good to hear that on, the carried interest.
There's clearly a broader philosophy here, Lisa, whether it's achievable or whether you take some steps towards achieving that broader philosophy. Maybe that's the ultimate goal.
The idea here that the $1.8 trillion plan that President Biden is going to lay out today includes $800 billion of tax cuts and credits for middle and lower income individuals while hiking taxes on the upper income, talking about the redistribution of wealth. That is what this plan sets to lay out.
Guys,
that's what it's setting
out. The broader
out.
plan here is to get reelected and to keep the House Democratic in November of 2022.
Tom, what's new is
John,
always Operation Re-election. I agree with you. It's always Operation Re-election, and the risk is that they overstep their mark.
Well, and
they
I
outreached a little bit too much.
And I wonder how much adding on this $1.8 trillion plan so soon after the $2.3 trillion proposal actually helps them get that through, or actually
Lisa,
undermine some of those efforts.
Well taken. Just the back-to-back here. But, John, over the weekend, I believe I saw the difference is like 5 seats in the House.
Yeah.
That's nothing.
Skinny margins, looking to do really, really big things. And ultimately, as you point out, Tom, what's important, not how this plays out in D.C., how does the electorate feel about it? How's it show up
the
in
good
polls?
news is David Weston is not as cynical as we are.
I'm looking forward to the coverage later. Tom Keene, you're so fired up this week. For a man in cash, very, very agitated about capital gains.
I am.
Renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and deaths. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It's 60 minutes away from the opening bell in New York City. Your equity market shaping up as follows. Futures unchanged on the S&P 500, 41.79 on the Nasdaq, down by about 0.1%. Alphabet absolutely flying. The cyclical story embedded in big tech, not talked about enough. The market gets it. Alphabet up by more than 30% going into the earnings, coming out of the earnings up another 5%. The cyclical side of the story, ad spending, nice. Cloud revenue, good. Later, Apple. Switch up the board in the bond market, 2s, 10s, 30s. This is how we shape up. Your yield up about a basis point on a 10-year to 164. Let's call it 164 at 163.78. 30s at about 230, 230.51 to be precise. We're still grappling with how quickly this cycle is moving. Think about a beach ball, pumped up with low interest rates and stimulus and fiscal relief as well. Held beneath the water, a mandated slowdown in America. You remove the hand, the ball goes flying. And that's the story in this economy as we snap back. What does it mean? Switch up the board for commodities. It means copper absolutely flying. What I wanted to bring you is just to think about where we've been over the last 10 years. At the top of the last cycle, 2010, 2011, early 2011, we saw 10,160 on copper. Right now, 98.24. The difference between now and then, just thinking about the people who had to take over at Rio, Sam Walsh, Jean-Sebastian Jacques, Rio Tinto, taking hold of way too much volume and capacity in the bust after the big super cycle that China fueled. This time around, the leadership of the likes of Rio, BHP, Anglo, those big global miners listed in London are going to be so reluctant to add capacity.
This sounds like a bar
and that's why so
conversation
many
at the
people
Dorchester
are
job.
so much bullish on copper going forward from here. I can't keep a straight face. I'd love to do LME Week later this year. Wouldn't you like to do that,
I would love
Tom?
to do that.
Wouldn't that be
You know,
awesome?
I was over there years ago, and we were in the bar. We had little umbrellas and the drinks and all that.
Should we explain what LME Week is?
LME Week is
gets
just,
together.
it's like where everybody gets together. And what's great about this, folks, is it's not that it's one big party, but seriously, John, it's a lot of really, really intelligent people whose idea of short term is 10 years.
So the way it used to go is that Cadolco would come, Chile would talk about setting copper prices, Tom. The way it's changed over the years is that the brokers used to take up an individual hotel on Park Lane in Mayfair, as you remember.
Really?
And you'd go from hotel to hotel, from broker to broker,
No.
just to see what was going on in the world of metals and mining in London. I understand the parties aren't what they were, and of course I'm not sure it even happened last year, Tom, but I'd love to see some of that stuff come back. Just bring some life back to the city again.
Yeah, it may come back to bring life back to global Wall Street as it is. We welcome all of you. You heard Julian Emanuel call this the most important day of the year, and we have been remiss to look at our economic data. Michael McKee joins us now as he prepares for his important press conference this afternoon with the chairman, and he has some of the tea leaves here. Michael, start with the trade balance. I care, don't I?
You care. It's very interesting that as we recover, we seem to be buying a lot more stuff from overseas. We don't have a complete breakdown, but the initial numbers for the March advanced trade goods deficit, $90.6 billion. And that's notable because that is the largest U.S. monthly trade deficit deficit ever for the month of March. It's definitely going to subtract from second quarter growth.
What's it mean for twin deficits before we get to inventories? I mean, is this something that guys like you, it's on your radar to worry about the combination of our fiscal debt, the speech tonight, and also this record trade level?
Well, there's a lot going on, and the person I'd hate to be today is the Forex strategist, because how do you combine the idea of a massive stimulus that in theory should boost U.S. growth in the dollar and this huge trade deficit? So it's going to be interesting for them to try to figure out what's going on. Exports were up 8.7% during the month of March, but imports up 7.6%. These are big percentage changes historically.
Lisa, that number I've never framed in my brain, let alone seen. A negative 90.6 is jaw-dropping.
And the idea here is that some of the stimulus money that U.S. households received ended up going overseas as people tried to pack their inventories with new cars and all sorts of toilet paper and toilet paper products. There is a question, though, Michael McKee, as you sit in Fed Chair Jay Powell's press conference virtually today. Is there anything that could come of this meeting that truly will be groundbreaking for Wall Street?
Probably not, because, for two reasons. One, the Fed knows that whenever they say anything about changing the stance of monetary policy, there's going to be a reaction in the markets, and so they don't want that now. And the second reason is because Joe Biden is speaking tonight about fiscal policy, his big program, and the Fed doesn't want to get drawn into that. So I would expect him to be quite quiet.
Michael, we're among friends here. That's not what we care about. Lisa was alluding to how rude they were last time with you. Are you going to get elevator music again when you ask a question?
I hope not. I think Jay Powell was anxious to call on people and avoid their questions.
Maybe in honor of the passing, the death of Al Schmidt, the giant of music recording, he did the room and created the sound of Africa by Toto. So maybe they'll play Toto when you ask your question today. Michael McKee with a really important question today. Look for that in the press conference with our
at the very end. Just at the very end.
Leave McKee. Michelle's there. Leave him for the end. Leave him for the. We begin with Torsten Slok with Apollo Global Management and their chief economist. Torsten, when you see this data and the historic moment of trade, are you elevating your GDP estimates and lengthening the boom economy?
Well, it is certainly very revealing for how strong the economy is. When imports go up so much, it is certainly, as Lisa was saying, a very strong sign that the stimulus checks have been buying a lot of consumer goods. That's been showing up in trade. We also have, generally speaking, that the economy is getting a lot of tailwind from excess savings in the corporate sector, excess savings in the household sector. And on top of that, the reopening, of course, just continues now with the discussions now just yesterday of the mask mandates changing. So this economy is doing very well. And the numbers this morning on the trade balance just confirms that your picture of the ball underwater that's coming up is certainly a good analogy. We are seeing an economy that's coming back very strongly.
Let's talk about inflation. Price pressure. As you pointed out, Torsten, this isn't just base effects. It's too easy to sit here. It's almost lazy just to say it's the base effects. We all know the base effects. It's more than that, isn't it?
It is, and I think this is a very, very important discussion for today, as Mike McKee just was mentioning for the press conference and the Fed. I mean, the Fed will continue to tell the dovish story about the unemployment rate is still 6%. This is just base effects. There is nothing really to worry about here in the near term. We're still waiting for the economy to come back to full capacity or the unemployment rate to come back to a lower level, which could be around 3.5%, which we were pre-pandemic. But as you're saying, John, if you look at the data for a number of different indicators, not only are inflation expectations going up for the household sector, you're also seeing that it's getting very difficult to find workers. Some companies are now paying workers just to show up for an interview. You're also seeing in a number of different indicators when it comes to the ISM, the regional Fed surveys from the Richmond Fed, from the the Dallas Fed, and the Denver area in particular, but also the Kansas City Fed. They have shown significant pressure, in particular the manufacturing sector. And all this is pointing to higher input costs. And as you just spoke about copper prices, that makes it more expensive expensive to produce. And the big question is, what happens if input costs go up? The two things can happen. Either margins can get squeezed or selling prices, meaning inflation, can go up. And we are seeing more signs of this not just being base effects. There is very strong demand in the economy pushing prices higher.
So how is your outlook different to the Federal Reserve's right now, Torsten?
So I think that in the near term, and if I type ECFC Go on my Bloomberg screen and I do the quarterly profile of how does the consensus expect core PCE over the next several quarters, it is quite impressive that the expectation is inflation will go up in the next quarter or two, and then will come down and be exactly 2 going into the end of this year and into next year. I think the risks are beginning to rise that Larry Summers is right. Or as Olivier Blanchard has been saying, this is not just overheating, there's a risk that this is like starting a fire. So there is a chance that inflation could be overshooting 2%. And the Fed might continue to say, well, that's okay. We have flexible average inflation targeting. We are allowing inflation to overshoot. But the big question is if long rates are also just going to take a relatively relaxed approach to inflation overshooting 2%. So I would say, John, to your question, that the key issue here really is that if inflation does begin to overshoot 2% for an extended period, one does need to look very carefully at how long rates, will long rates just say, okay, that's all right, we accept that? Or will long rates begin to say, well, wait a minute, if I'm a bond investor and I see higher inflation, that erodes my returns, and therefore I need to be compensated for that risk.
What does an inflation fire look like? Not just burning hot, but a fire. I mean, are we heading back to 1970s? When we say that, people scream, no way, we're no way heading back to that. But parse out the new inflation fire.
Yeah, that's a very important question, Lisa. I would say the new inflation fire is very similar to what we had in the late 60s, where inflation gradually went up and it stayed at a relatively elevated level. In this world we live in today, the levels of inflation, of course, are different relative to what we had in the late 60s, from 65 to 1970. But in my book, that would be inflation at or above 2.5 on core PCE, which, as you know, is the Fed's preferred measure of inflation. If we get to those levels, and in particular if we get there just for several months, then I do think that bond investors will really start to become worried. That's not my baseline scenario. I still think that inflation is under control, but we do have a few months here where we could risk some turbulence in credit, in equities, in risky assets because of this issue that rates risks and inflation risks are more elevated. And then the final point of this is, have a look on your Bloomberg screen on rates vol. Implied vol in rates is very, very elevated. So the MOVE index, for example, is very elevated relative to, say, VIX, which has just come down. So what is the shock that people are so worried about in rates markets that people in equity markets don't seem to care too much about? Same thing with credit vol, it's also very low. So there is a disconnect between volatility. Implied vol in rates markets is very high relative to how low implied vol actually is in almost all risky assets. And I think that's telling us something about how investors are thinking about the inflation risks for the next several months.
Torsten, really smart. Torsten Slok there, Apollo Global Management Chief Economist. On the story in the American economy right now, to bring you some of those forecasts from the ECFC screen, the immediate estimate for CPI for the economists that we track here at Bloomberg, 2.6% for 21. Then the drop down to 2.1%. That's what Torsten was getting at here, Tom. That seems to be the view right now in line with the Federal Reserve. Some doubts raised by Torsten and maybe captured by volatility and rates.
I sort of feel like I felt 12/31/20, John. You know what? There's a consensus. There's a zeitgeist out there, if you will. And boy, has it been wrong in the past. Why is it going to be any different now? I mean,
listen to the corporations.
Exactly. That's exactly what I've been saying is listen to business. They're buying back stock.
Coming up on the Open, we'll continue the conversation. JP Morgan Asset Management CIO Bob Michael joining us. Looking forward to that chat.
Be on the real yield
a little bit
as well?
later. I don't know. I'll ask him, Tom. Do you want him to drop by?
I think you could see that.
He might stay at work late, a little bit later on Friday. We'll do the show at 1 p.m.
Somebody earlier was auditioning
for it. What time's the Fed show?
I don't know. My people
don't know. It starts at 2 p.m.
It starts at 2 p.m.
Wake me up.
When's it finished, Lisa?
Well, 2:30 is the press conference.
It's 2:30 then.
I think
Tom carries on until 3:34.
Yeah, we just go across the street and get a beverage of our choice.
Sleep under your desk.
From New York City, Julian Emmanuel calling today what could be the most important day for markets in 2021. The take from BTIG. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden goes before a joint session of Congress tonight to try to sell his historic spending plan. This president wants money for childcare, universal pre-kindergarten and tuition-free community college. He plans to pay for it with tax hikes aimed at high-income earners. Republicans already have announced their opposition, and some progressives are calling on the president to do more. And President Biden's plan would do away with private equity's most lucrative tax break. Fund managers rely especially on a share of appreciation in the assets they oversee. That's known as carried interest. Those profits have been taxed as capital gains. That tax break would go away under the president's plan. He also wants to raise the top rate on capital gains. The UK is working on a digital coronavirus passport. The British initiative is based on an existing National Health Service app. It will be updated or adapted even to help travelers prove they've had a shot or tested negative for the virus. France is starting to test a tracing app updated to contain records of shots and tests. And Spotify has raised its revenue projection for this year. The leader in music streaming increased subscription prices and attracted more advertising. Price increases for a range of products will take hold in markets including the US and the UK. Global news 24 hours a day on air and on Bloomberg Quick Hit, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, the party, makeup will bounce back.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
All of the inputs are going to go up a great deal in terms of their cost. 16 months of inventory needs to be produced in 12 months to not only satisfy current demand, but to refill the supply pipeline. All of that's going to take place now, and that will cause some delays, and it also will cause prices to go up.
David Balin with Citigroup, really one of our best conversations of the day. Thrilled you could join us for that on radio and TV, and we drive forward the conversation. Now, certainly what has changed, and John's mentioned this off the London Metal Exchange, is commodities, not all commodities, but most commodities lift up, and some of them with a vengeance. Oil off when Lisa was buying at a negative price point, up to $60 a barrel. Now we see it within copper and the surge there, and palladium at a record high the other day. Paul Wallace is one of our most interesting people at Bloomberg News. He's got that romance of him of jetting around the world in commodities, covering the space for years, and we're thrilled Paul Wallace could join us from Dubai this morning. Paul, from where you sit in the Middle East and in North Africa, is it the beginning of the commodity cycle people have waited and waited and waited for?
Hi, Tom, and thank you for that introduction. Sadly for the Middle East, a lot of people are suggesting, including in this region, that if there is a commodity supercycle, that oil might not be part of it. For various reasons. Metals are obviously flying. Metals have the advantage of sort of being major beneficiaries of the green energy transition because of how they're needed in things like EV batteries and wind turbines. With oil, we've obviously seen a huge rally this year. We're up about 30% with for both Brent and WTI, but that's come off the back of huge production cuts by OPEC+. And even though they've raised output in the last couple of months, they're still down about 6 million barrels a day or something. And that's, I think, what's going to be key for the rest of the year. Just how quickly do the likes of Saudi Arabia and Moscow bring back those spare barrels.
And Paul, this goes to a larger debate within the commodity sector. And just to stay at a 30,000-foot view for a second, this idea that producers are more disciplined this time around. John was talking about that with the copper producers, with the miners, in all levels. They are more disciplined, which means that prices could go that much higher, especially with all of these infrastructure spending plans. Is that consistent with what you've seen, that discipline really remains the presiding sentiment among producers of all sorts of commodities?
It really does. As you mentioned, it seems to be the case with sort of non-oil commodities, but it's also definitely the case with oil at the moment. I mean, you've got OPEC+, which is a 23-nation grouping, extremely diverse. You've got everyone from Saudi Arabia to Russia to Iraq to Nigeria to Angola. And these governments all have different needs. I mean, they all need the money because in some way or another their economies took a big hit last year. But the amazing thing is they have managed to stay cohesive for almost a year now since they began their oil production cuts at sort of during the height of the first wave of the pandemic. A lot of people wrote OPEC+ off. They said it's only a matter of time before the alliance falls apart and every producer just thinks it's free fall and they pump as much as they can. But that's not been the case, chiefly because of what Saudi Arabia and Russia have done. They've managed to keep things together. And as I said, they're holding back about 6 million barrels a day at the moment, which is a lot of lost revenue because obviously revenue is production multiplied by the price. If you cut your production as much as they are, then you're going to take a hit as far as revenue is concerned. So it's been quite impressive as far as OPEC+ is concerned.
Paul, we talk about this in the context of earnings. Company after company have come out and said that their input costs are surging. Based on your conversations with the producers themselves, both in the shale patch and the oil patch in the Middle East and elsewhere, do you think that these inflationary pressures, these input cost increases, have staying power well beyond what people are certainly counting?
I think so. I think we are getting to that point where certain companies that use a lot of commodities for making their products, or countries that are heavy commodity importers, are hurting. And as an example, in the oil market, the most obvious case has been India. In the last few months, India has been speaking out about how oil prices have gone too high too fast, and it's actually criticized Saudi Arabia and effectively blamed Saudi Arabia, saying that it's Saudi Arabia's fault that OPEC Plus is not raising production as quickly as India would like. So I think we are getting to the point where the people who don't, or let's say the people in the companies that don't benefit from rising commodity prices are starting to speak out. And that could be something that puts sort of downward pressure on them. I mean, oil has kind of been flat for the last sort of 5-6 weeks. And I think part of that is because importers are under strain.
Paul Wallace, thank you so much. A brief from Dubai, Bloomberg editor for oil, energy, and commodities in the Middle East and Northern Africa as well. It is a most interesting Wednesday. An open question, Lisa Abramovitz, what will you focus on?
Today, I'm curious about Chair Powell. I'm curious how he's going to tee the line between some of these earnings that we get and all that inflationary pressure and this idea that they have the tools to keep it in check and that they will continue to remain incredibly accommodative. I'm also very interested to see what Apple and Facebook have to say and what Apple's going to do with all that cash. You think it's just going to be buybacks, right?
Well, I'm going to go to use of cash, and I don't know what they're going to do. I don't have a clue what they're going to do with it. There's a lot of speculation and rumors on it. We'll wait till we see that, and our team will assist on that. But I'm going to dovetail them, Lisa, and that the boom that we see in big technology and among the prosperous that the president will come up with tonight, I would bet that will be directly addressed by Chairman Powell. He has been press conference after press conference, a growing tone of concern, Lisa, over the Fed's project started in Chicago with President Evans there, with the basic idea of the inequalities and growing inequalities of the nation.
Right. Substantial progress in labor markets. It doesn't just mean a number. It means also equaling out the playing field a bit more because this pandemic hit the lower income individuals so much harder, and those are typically the individuals who lag behind.
And growing evidence there. I think just in the last number of weeks, Lisa, we were actually talking about this at the dinner table the other night, how the bargain before was the upper decile and the lower decile did well. And that's changed now to where it's just the upper two deciles say, and the lower decile really hasn't participated in this pandemic.
And we can dovetail that into the conversation about the savings rate and how much excess savings people have. Is it because people receive checks from the government, or is it because wealthier individuals didn't go on vacations and saved all that money? And are they going to be the big spenders if you can only go on so many vacations?
Don't tell Pharaoh, she just nailed it. She just totally nailed it. That was the best slide. That was the best slide. Yeah, the mics really work, folks.
Yeah, exactly.
That was the best slide in Peter Hooper's 55-page deck yesterday on the massive savings of the haves in America. This sets us up for an extraordinary day here at Bloomberg News, much more than finance and markets. David Weston leading our coverage tonight of the President of the United States, and before that, earnings with the close, and before that, I think there's a Fed show at 2 p.m. Stay with us.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center.
to tech earnings,
The COVID boost is gone.
Bloomberg breaks the numbers as they drop
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
and furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season. President Joe Biden, nearing 100 days in office, addresses a joint session of Congress. COVID, the economy, the plan forward. Today, 8:30 p.m. on a special edition of Balance of Power on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. What a day we've got lined up for you. From New York City for our audience worldwide, good morning, good morning. The countdown to the opening bell starts right now. 30 minutes away from the opening bell. Equity futures unchanged. We begin with the big issue. Investors preparing for Chair Powell.
What does the Fed do?
The Fed is telegraphed a do-nothing policy for the time being.
They have boxed themselves in
since their last meeting.
We're just being bombarded with economic information.
The data is not just better, it's better than expected.
The longer that they hold,
If the data not only surprises to the upside, but persists to surprise to the upside,
the harder it is going to be.
Okay, traders, are you ready to trade euro? Today look like we're busy with euro pairs, yeah? And I'm placing again order to sell short at 120.69.5. I even moved previous our lines to place order to sell short at 120.69.5. Okay, I remove this. Okay, so if you want to make money on euro today, follow me, follow my trade, and do what I do. You still have time to place order and sell short euro against United States dollar. Okay, guys, stay with me, and I'll speak to you later after we will get filled. Okay?
But they have a different plan now. You take a look at this chart here, and you can see on the left-hand side, that's what they used to do. Inflation going up, they'd raise rates. But right now, on the right-hand side, inflation's going up, and you can see how inflation expectations have just rocketed up recently. They're not raising rates. That's their bet. The bet is that financial conditions are even easier, and they can keep the economy going, because if you look at the next chart, you see that inflation, along with financial conditions, continue to decline. Now this is the Goldman chart. This is the lowest financial conditions, loosest conditions ever. But look at where inflation is right down there with them. The Fed doesn't think it will diverge, or not quickly. And if it does, well, Jay Powell will say, we have the tools to deal with it. The problem with that is the tool is raising interest rates. And if you look at this one final chart here, you can see what happens. The Fed starts raising interest rates, and they go to...
Okay, guys, position open on euro. How many times we traded today? 3 or 4 times, yeah? 120.69.5. So stay with me. You had your chance to follow my trade and place an order. Right now, it's moved down. If you want to practice your trade, just watch how we make profit from day trading. Okay, if you want to find out more about our strategy, please go to company.co.uk website. You need to purchase strategy. This is not free. And otherwise, you can follow my trades. Also, you can see on our streaming channel, the all information about strategy, about webinars, everything you need to become day trader available on our channel. Okay, we trade real money. We don't trade some imaginary funds, imaginary money. So everything happened live in front of you. I'll speak to you later, guys. Stay safe.
Traders aren't going to be paying attention to any talking about tapering, anything they say on inflation. But long and short of the story is that they aren't expecting any changes really for some time. When you look at the way markets are pricing the Federal Reserve hiking rates right now, a rate hike of 25 basis points isn't seen until the end of 2022, nearly 2 full hikes priced in by the end of 2023. Now, those bets had been pulled back earlier in this month, but they are starting to tick up again. As for the Treasury market, it had been a relatively sleepy couple of weeks with the 10-year yield hovering below 1.6%, but that has changed in the sessions leading up to this Fed meeting. The 10-year yield is up 10 basis points, 9 basis points now in the last 4 days. A 5 basis point move yesterday alone, and today we are higher once again to just under 1.63%, the highest level in about 3 weeks. And what this really all boils down to, John, is inflation expectations. We have seen a boom in commodity prices, everything from the ags to the industrial metals, and that is feeding into the inflationary narrative. With that, we've seen break-even rates picking back up pretty sharply. The 10-year break-even rate, which is how the market is gauging inflation expectations over the next year, is sitting at 2.42%. That is the highest since going back to 2013, and you can bet Jay Powell is going to have to try and dance his way around addressing that today, John.
Looking forward to that presser a little bit later. Full coverage, special programming here on Bloomberg. Katie, thank you. JP Morgan's Bob Michaels saying the only thing markets want to hear is when the Fed plans to begin the tapering process. He writes the following: our expectation is that Jackson Hole in August will be the perfect time for tapering talk. Enough strong growth and inflation data will be evident over a number of months. But for now, he'll brush those questions aside. Bob joins us now for more. So, Bob, let's start here because I know it's where you're focused too. A 5-year chart of where this 2-year yield has been. And over the last 12 months, it's lost a heartbeat. I talked about that through this morning. What does it take to unanchor, de-anchor the front end of the yield curve? What's the catalyst for that, Bob?
Well, hi, John. I've heard you use the analogy of the Fed is effectively holding a beach ball under the surface. And that beach ball, one of the beach balls, is the 2-year Treasury yield. So as long as they taper and continue to buy 80 billion or so in short duration treasuries every month, they're going to keep the 2-year Treasury pretty close to the Fed funds rate. We've looked back over history. It doesn't always stay there. If you go back to 92 to 1994, after the S&L crisis, it got to 175 basis points away. There's a lot of room for the 2-year to rise. I don't know if it goes 175 basis points, but 50 to 100 basis points above the Fed funds rate once the Fed begins to taper and get out of that market.
Normalization is a word that gets used, Bob, a lot. And I'm uncomfortable with the word because I'm not sure what getting back to normal even means anymore for this Federal Reserve. Your timeline for so-called normalization, what informs that, Bob?
You know what normalization means to me? It means letting the market set the price for the cost of the U.S. Treasury and other businesses and households to fund themselves. And right now, we're not doing that. The Fed is doing it for us, and other central banks are doing it for us. So they need to find a graceful way to exit the market and let market dynamics take control. For us, it starts with tapering. It starts with your action hero, Super Michael McKee, at the press conference, boxing Jay Powell into a corner and asking him if the Jackson Hole August meeting is the right time for them to start the tapering conversation. They should start tapering by year end, do it gradually. They don't want to be too disruptive. And I think by 2023, begin to normalize rates. And I think over the next 5 years, we'll see a 3% Fed funds rate and a 4% Treasury. Now, there's a lot of policy response around that. Yeah. We've got, proposals coming out of the administration for stimulus with tax reform as part of that. So that could change all of that. But to me, that's a normal, rational trajectory to get to something that looks reasonable.
Bob, let me repeat those numbers. 3% Fed funds at some point in this cycle, 4% 10-year yield. I wish you were on the program yesterday with Mike Collins of PGIM. Take a listen to what he had to say to me in yesterday's show.
We hit 175 on the 10-year, Jonathan. As you know, that is effectively pricing in, what I call the Fed's perfect world or dream scenario. Yields tend to peak when the rates of growth peak, and we're going through a peak growth rate right now.
Bob, let's pick up on that final line. Yields tend to peak when rates of growth peak, and we're going through a peak growth rate right now. Why is peak growth a useless concept as far as you're concerned for the trajectory of this 10-year yield?
Because it's an artificial growth rate. The government shut the economy down. It's reopening. Now there's a lot of stimulus in the pipeline. Things are reopening. We're talking about additional stimulus coming, perhaps another $4 trillion. That's a lot of growth coming down the road. I also go back to 2018. We almost got to a 3% Fed funds rate, and we almost got to a 4% Treasury, and that was in an era of austerity when the central bank go-to policy was to talk about fiscal restraint. This is all about fiscal stimulus, and this is all about MMT.
Bob, a conversation that you and I will continue. I'm looking forward to catching up with Priya Misra of TD as well. Bob Michael of JP Morgan there. Stay in close. He'll join us in a couple of minutes' time. Let's turn back to this market. Unchanged on the S&P 500 at the moment, but the earnings story over the last 24 hours has got to be Alphabet. For more, here's Abby.
The earnings story is very robust indeed, John. Beneath that calm surface or flat surface, big movers. And you were just mentioning Alphabet, parent of Google. Shares are set to open at a new record high. This after the company put up a blowout quarter, beating adjusted earnings by 17%. To put that into perspective, that is almost $21 per share just for the quarter. That's extraordinary. This on $45.6 billion. That was also a 7% beat. Their business boomed on the pandemic and now on a reopening blitz around marketing. In addition, they announced a $50 billion buyback, so really satisfying all of their investors. A new all-time high, most likely on the open for Alphabet. Turning to some other movers, though, to the downside, Microsoft, they put up a really strong quarter. They beat sales and earnings for the 9th quarter in a row, but with the stock up 50% over the last year, investors wanted more. Texas Instruments, they beat, but the second quarter sales outlook is only in line. Discovery, a big miss there. That stock really plunging on this. They're streaming and ad sales week. And then finally, Pinterest, they beat, but they're warning on slowing growth on U.S. reopening, which is obviously a positive for the economy. So it's interesting to see all these stocks that did so well a year ago as we went into the lockdown. Now we're seeing the reverse, John. That stock down sharply.
Payback for pull forward. We've seen that at Pinterest. Kelly Lyons mentioned it earlier. We saw it at Netflix last week as well. Alphabet, this is such an important story. We spent the last 6 months thinking about a better economy.
Traders, are you ready to trade Bitcoin? Excuse me. The price I'm looking to buy, 54,856, 856 pounds. So I'm going to place an order to buy Bitcoin at 54,856. Let's see if I'll be able to show you on 1 minute chart. Yep, I think so. Okay, 54,856. Okay. Okay, guys, order placed. And let's see, if you want to trade Bitcoin, here is your chance. You can enter, it's still Bitcoin higher, price still higher. So you can still enter the order to buy Bitcoin at price 54,856. I want to point out that when we trade Bitcoin, we don't calculate profit or loss based on the pips. We calculate based on percentage, 0.1, 0.2, and so on. Okay, same amount of money, 0.1% gives us 100 pounds in profit, and so on. If Bitcoin will give us 1% in profit, it will give us 1,000 pounds. Okay, so order placed, look like it's moving down to get this order filled. Let's see if we'll be able to do it right now. If not, I will speak to you later when it will get filled. Okay? Come on. Now, okay, guys. I'll speak to you later after when we will fill these. Yep, okay, that's it. We're open position, long position on Bitcoin at 54,856. Okay? Stay safe. If you want to find out more how we trade, you need to get the strategy on company.co.uk. You can still register for webinar, for tonight's webinar. So please go to our website and you can register for webinar. And I will explain you everything, strategy included in webinar. You can see what exactly is all about, how we trade, why we place order, the specified price, why price not different. Everything I will try to explain over the webinar. Otherwise, I'll speak to you later and stay safe.
Valuations, particularly sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
I think it's a good thing that the administration put forward a plan to invest in America that is paid for. That's the responsible thing to do. And I believe that everyone should pay their fair share. Compared to what Republicans did when they had the presidency and the majorities in Congress, they passed a tax bill that vastly benefited the wealthiest Americans while leaving a huge hole in our budget.
Representative Stephanie Murphy supporting President Biden's outline for funding his American Families Plan. Republicans across the aisle pushing back on a number of proposals.
I'm really concerned about what President Biden is laying out, dramatic increases in the capital gains tax. You add the Medicare 3.8% surcharge, you add state taxes, it's going to put capital gains rates with state plus federal north of 50%. That's a big problem as it relates to global competitiveness and encouraging savings and investment. It's a radical move by the Biden administration, and I won't support it.
He won't support it. Many others won't either. Joining us now is Bloomberg's Emily Wilkins, joining us now from D.C. Emily, we'll hear from the president later in an address to Congress. That's a proposal. What's achievable?
What's achievable here might be far less than what the president is putting forward. We've already heard West Virginia Senator Joe Manchin, a really key moderate, one that everyone in D.C. keeps their eye on, come out and say that he wasn't super happy with the tax proposal the president has put forward. He thinks that the government might need to look instead at how much taxes they are getting from companies, making sure that companies are paying their fair share, that loopholes are closed, that necessarily raising these tax rates might not get the result that the government's looking for if these loopholes still exist for companies and wealthier individuals. But however, there is an urgency among Democrats to get something done. There is a willingness to get something done. It's going to be a little bit more difficult this time than what we saw on that $1.9 trillion COVID package, because there is just so much more in this bill, but they've got some time to get it done. The kickoff speech is tonight for the second part of this plan for the tax proposal. Congress already has some ideas of what changes they'd like to make. Leaders already have an idea of where members in their caucus stands, and I think we're going to be seeing Biden's proposal get tweaked a little bit as lawmakers get their hands on it and it starts going through the legislative process in Congress.
Tweaked a little or maybe a lot. Emily, it's good to catch up. Emily Wilkins down in Washington, D.C. The events today just piling up. A news conference with the Federal Reserve Chairman Powell, a decision a little bit later. Then we have the address in front of Congress from the President of the United States. Throw some earnings into the mix too. Take a listen to what BTIG's Junior Manuel had to say.
Between hearing from the world's largest company by market cap, Fed Chair Powell, and President Biden, particularly in this environment where we're having such an intense debate about inflation and whether economic growth is really in the low sixes, as consensus states that it is, or really more like 8%, and whether the Fed will have to react to that. And of course, we're going to hear that we're going to have more spending and higher taxes tonight from President Biden.
And how do we process all of that? Priya Misra of TD Securities joins us now. Alongside us still, Bob Michael of JP Morgan. Priya, let's start there. The next fiscal steps are increasingly really, really difficult to process and price in this market. How do you approach it?
Hi, John. So yes, I think, we've heard, so some of these have been leaked, some of the proposals, but I think today is going to be important. I don't think the market's pricing in a $4 trillion. Just because it's too early, we still don't have all the details. All the Democrats are not on board. There's a bunch of issues around SALT, around why aren't we doing this through a bipartisan process. I think today kickstarts the process. Then we see how the negotiations go through. But I think the Democrats are serious. And when I think of the opposition from the Democrat side, I think there's plenty of negotiation there that can get them on board. So the market has to start to process impact on growth and inflation. And then all the tax offsets, what does that mean for Treasury supply? That's something that the rates market is spending a lot of time on. What's the impact on the deficit? So over the next few months, I think we'll have to start pricing it in. I think it's an unequivocal positive for growth and inflation. On the Treasury supply front, depending on the tax offsets, it may not mean a whole lot of Treasury supply, but we have enough to contend with in any case.
Well, at the moment, it just seems like the uncertainty around these plans has taken away the tailwind that we had behind higher Treasury yields going into the end of March. That's faded. The emphasis has shifted. They were the words of Mohammed Al-Arian on this program the last couple of weeks, Bob. The emphasis has shifted to redistribution away from pure fiscal deficit spending down in Washington. How do you get your hands around the next steps? And with Priya's question in mind, do you think we're taking it seriously enough? The threat of more spending in Washington. I call it a threat, so don't criticize the use of that word too much. The threat of spending for this bond market.
I think that's a really good question, John. And look, I'm a 40-year debt investor. I spend every day worrying about how this debt will be paid back and where the revenue will come from. And now we're talking, in addition to the $3 trillion from CARES and the stimulus bill, another $4 trillion from the infrastructure bill and the American Families Act. So that's a lot of spending. Priya's right. That's a lot of growth and inflationary pressure. That means the Fed is so far behind the curve. If a lot of this comes through, their catch-up has a long way to go. Maybe that first dot of 4.25% a decade ago doesn't look unreasonable. Then I start thinking about what does that mean for the Treasury market? Well, it's going to take a while for the taxes to come through. They'll be collected over years, not months or quarters. So a lot of that's going to have to be funded with the Treasury market, which makes 1 5/8 or 1.6% look ridiculously low. It looks like yields at a minimum have to double or go higher once the Fed allows the market to set prices again.
Torsten Slog was on the show with us on Bloomberg Radio and TV a little bit earlier, Priya, and he was talking about the higher rates volatility that you don't see reflected in equities so much. And I just wonder whether this is part of that. The higher rates vol, just reflecting the uncertainty around fiscal spending and the uncertainty around inflation too.
So I think rates vol is compressed largely by the Fed. I mean, if the Fed, there's the QE part that's keeping real rates low, that's keeping the long end low. But there's also this front end, the FAIT framework, is keeping the front end pinned. If you don't allow the market to price in hikes over the next couple of years, it's very hard to see how the long end can get completely unanchored. So I actually think the Fed is deliberately keeping rates vol low, and that's allowing real rates to be low, that's allowing risk assets to do well, which is why today's meeting, I don't think we'll get that signal this meeting. But Chair Powell has said we're a long way away from that sustained further progress. When does that long way become we're getting there? We think it's closer to year end. So that's when that rates vol really starts to kick in. I don't think the Fed can communicate so well that there's absolutely no impact of tapering. I think we run the risk of another taper tantrum. That's when I think every risk asset will have to pay attention to rates vol.
Yeah.
I just don't think we're there yet right now. I think the Fed wants to be really patient right now.
Priya, laser focused on the language you just used, one single word, allow. Bob Michael, does it come down to the Fed allowing these things to happen?
I think it does, and Priya's right. To a large extent, the Treasury curve is tethered to the Fed funds rate. Even in our minds, you can't get the 10-year much above 2% with the Fed at 0 because then the break-even dynamics of staying in cash look very poor. And of course, you get the flows that come in from overseas. Once they start to let go of the market with tapering and then telegraphing when they're going to raise rates, that's when you'll see where the market will price all this debt.
Bob Michael of JP Morgan, Priya Misra of TD. Guys, Always good to catch up. Thank you. Coming up, the analyst action. You need to know. That'll be next in our morning calls. And later, the big tech earnings parade marching on with Apple, Facebook reporting after the close. That conversation still ahead with Franklin Templeton, Stephen Dover, and Troy Gajewski of Skybridge Capital. 7 minutes away from the cash open in New York City. Equity futures up 2 points. We advance to 41.80. This is Bloomberg. We're about 5 minutes away from the opening bell this Wednesday morning. Good morning from New York City. Equity futures up 2. We advance on the S&P 500 just a little bit. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin first up with Citi upgrading Viacom CBS to a buy. 56 price target. The analyst expecting upcoming results to fuel a rally after shedding more than half its value in just 6 weeks. The second call from Cowen upgrading Ralph Lauren to an outperform. The analyst citing an underappreciated international business and improving digital trends. And finally, BMO upgrading UPS to market perform with a 195 price target. The analyst highlighting the company's productivity initiatives and better than expected quarterly results. That stock is down by about 1/3 after a big rally yesterday. Up next, the big tech earnings parade continues. Apple, Facebook after the close. That conversation still ahead with Franklin Templeton, Stephen Dover, and Troy Gajewski of Skybridge Capital. From New York, this is Bloomberg.
our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
25 seconds away from the opening bell in New York City this morning. Good morning. Going into that cash open, equity futures, the price action there just a little bit muted. We're going nowhere on the S&P 500, up a little more than 2 points. On the Russell, we're negative about 0.2%. On the Nasdaq, down by about 1/10. Apple, Facebook, after the close. There's your opening bell this Wednesday. Switch up the board into the bond market, going into the Fed. Yields creeping higher in yesterday's session. Some soft auctions this week. Yields higher just a little bit today. We're through 160, 162.71, and off the highs of the session today. In the FX market, euro dollar negative 0.2%, 120.68. Crude higher, traveling north up by a little more than 1% to $63.74. That right there is your cross-asset price action this Wednesday. With your movers at the market desk, here's Abby.
John, we are looking at a tale of two stories for big tech. And of course, I'm talking about Alphabet and Microsoft. Alphabet opening at an all-time high. Microsoft shy of that $2 trillion market cap. Alphabet, of course, put out a huge blowout quarter, beating sales and earnings, helped out by the cloud and ads, the pandemic spending, plus the reopening toward marketing, also a $50 billion buyback. Microsoft, on the other hand, beat for a 9th quarter in a row, top and bottom, but the stock up 50% over the last year. Investors wanted more. As for some of the chipset reported, AMD, this stock is sharply higher. They put up another big beat. Their 2nd quarter sales forecast also beat. Teradyne, which offers testing equipment for chips, soaring up 6%. They beat. They offered a strong outlook, so strong, in fact, Stifel is calling it a quote-unquote showstopper. To the downside, though, Maxim Integrated down 1%. They beat. However, they have suspended guidance, something that no investor wants to hear, so there won't be a call there. Texas Instruments, a strong quarter, but the 2nd quarter sales forecast, unlike AMD, their competitor, just in line. And then finally, just to make it a little bit more macro relative to the reflation trade, it is in order, John, because of course we have yields up for a 2nd day in a row. That's helping out the banks, that yield curve steepening, and oil up for a 2nd day in a row as well. So big oil and smaller oil higher, green on the screen for some of those reflationary sectors.
Those sectors have ripped year to date in 2021. Thank you, Abby. Thank you very much. 41.91 on the S&P 500, a marginal move higher on the session, up by about 4 points. Your intraday all-time high, 41.94. Right now, we're just short of that. We printed that, of course, on April 26th, just below that all-time high at the moment on the S&P 500. We've talked a lot about the cyclicals. We need to talk about the cyclicals within big tech. Alphabet just blowing it out of the water in yesterday's session after the close, of course. Microsoft have been leading some of the gains recently, too. Let's get some of the price action over the last year with Bloomberg's Kelly Lyons. Kaylee.
Well, John, the bar for some of these big tech companies has been extremely high because they have seen their business booming over the course of the pandemic, and their shares have been bid up accordingly. But what that means is that a lot of good news has already been priced in. When you look at the S&P 500 information technology sector as a whole, it trades at a forward PE multiple of about 27. For Microsoft, which you were just mentioning, it trades at a premium of 33 times forward earnings. That's why you aren't seeing the reward in the shares for a solid earnings report after the bell. Good just isn't good enough when so much has been priced in. You kind of have to leave expectations entirely in the dust, like Alphabet did. Now, of course, over the course of earnings season thus far, the information technology sector is up about 1.6%. That's basically in the middle of the pack on a sector basis, in line with the broader market in terms of headline performance over the last 2 weeks or so. But for the companies housed within the tech index who have reported results already, the average share price reaction the day after reporting is 0.25% to the downside. Of course, earnings season is not over yet. We have more mega caps due after the bell today. Apple and Facebook, they, along with the other mega caps we've already gotten, make up a large chunk of the $18.6 trillion in market cap reporting over the course of this week. For Facebook, I'm watching two things. One, ad growth? Are they going to benefit from a digital advertising boom in the way we saw with Alphabet? And then also user growth. Are they going to have seen the pulling forward of growth like we saw play out with Pinterest overnight? Then for Apple, Macs, iPhone sales, that's going to be important. Any commentary around the semiconductor shortage could be as well. But again, John, it comes back to the question of will any kind of beat be rewarded given the valuation that stock enjoys, John?
That's a good point, Kelly. Thank you. Certainly rewarded over at Alphabet. Listen to this line from Microsoft and Satya Nadella. I repeated this a little bit earlier this morning. I'll do it again for you. Over a year into the pandemic, digital adoption and adoption curves aren't slowing down, they're accelerating, and it's just the beginning. That's the line from one of the biggest companies on the planet. It's just the beginning. The secular growth stories, the cloud business over at Alphabet doing nicely. I think a lot of people looking for more of the same maybe from Amazon tomorrow too. Franklin Templeton, Stephen Dover joins us now. Troy Gayeski of Skybridge Capital with us too. Stephen, I want to start with here with the cyclical plays. Spent a lot of time talking about energy, the financials. To see the cyclical story embedded in a stock like Alphabet performing so well, just a reminder of these big tech plays and how they're hard to ignore, Stephen.
I think that, I mean, what a week and what a day with so many different announcements. We're still very positive on the cyclicals. Today we're talking about all these amazing earnings with the technology stocks, but you do make the point that it looks like cyclical stocks are still having a lot of opportunity. But I think the difference with cyclicals is this first quarter isn't really indicative of what we need to see. We need to see forward guidance, and we need to see how they're going to do through the rest of the year and forward.
Some of the concepts, pent-up demand versus payback, you saw that in Pinterest. Katie Lyons talked about that earlier on. We saw that in Netflix last week too. Then there's other secular growth stories that accelerated last year, Troy, that are still accelerating. You see that in the software story. You see it in the cloud business. It just seems to me that things are getting a little bit more nuanced, Troy, as the year progresses, that it's not some big blanket macro trade as it was maybe in the last 3-6 months.
Oh, yeah, certainly. There's going to be more differentiation and dispersion going forward than there has been in the past. And, you know, if you think about the dispersion last year, it was mainly big cap tech and growth stories from really the pandemic bottom to November. And then from there, you know, it's cyclicals and value outperformance, right? But, you know, I think you hit on a very key point for investors to focus on is that where you can find secular growth stories that also have cyclical upside combined with attractive valuations, that's really where the hedge fund industry is most focused. So whether it's large cap names, you know, like Facebook or Amazon or Google, or if it's more smaller tech names, 125 billion market cap for Applied Materials, for instance, which is a cyclical and secular growth story. That's where the hedge fund industry is focused, as well as, you know, certain big growth opportunities in healthcare, particularly in biotech, for cancer therapeutics.
Troy, you went through the bullet points of what you'd be looking for, and then I stopped and thought, at acceptable valuations. Troy, that's the tough part of this piece, isn't it? I can think of the companies, Alphabet being one, the Walt Disney Company being another. They've got that barbell embedded in the stock, the reopening play. They've also got the streaming content too. Then we get on to valuations. How useful are valuations right now, Troy?
Well, they're more useful now, given that, you know, money supply growth is still moving at a breakneck pace, but certainly not the frenetic pace of, you know, 120% annualized of Q2 of last year. We're down to about a 18% annualized growth rate. So that's the trick, right? Is not overpaying. You know, finding areas where, you know, you're paying a reasonable valuation. You can't find anything cheap, right? I mean, like, just to argue that banks are cheap or energy's cheap is ridiculous, right? But if you can find things at 18 times, 22 times, 24 times forward earnings that have very good free cash flows, which is another metric that hedge funds are very focused on, you know, relative to history, which is encouraging for the broader market. That's where we think we'll see more of an alpha proposition. And then again, in terms of big growth, you know, the market really hasn't been paying as much attention to biotech the past 3 months, had a very strong, you know, close to last year and then became an orphaned out of favor sector. But that's where, you know, you have 20, 30 years of work coming together for advanced cancer therapeutics. In particular, not exclusively, there's obviously orphan diseases as well, where you can have the double, triple potential, which obviously you're not going to get in any mega cap stock right now.
Stephen, I was just going through your note, and it just seems to me that you've become a little bit less bullish recently. Is that a fair characterization, and can you tell me why?
Let me give some nuance to that. If we look, you're talking about valuations, and if we look at valuations since last June, the valuations have basically been flat. All of the progress in the market has come from earnings growth. And that's what we're looking at going forward. And especially with the cyclicals, they have to come through for the rest of the year and actually come through with earnings. And what typically happens is that the multiples, as we get into the growth, the multiples start to fall. So we're just pulling back some of the gains that we've had. We've been very bullish for this last year. So in your portfolio, you have your allocation, then you have that amount that's come from the gains, and we think some of that should be pulled back. So just to be clear, still very positive on the market as a whole, but there's not as much upside as we saw over the course of this past year. And so now we'd be looking at a little bit of a pullback.
Stephen, just in terms of the conversation around price pressure, how is that shaping your outlook as you look at markets at the moment? Just to cherry pick one data point, 3M yesterday, we weren't talking about the big cyclical upswing with that stock and how they'd leverage it. We were talking about transportation costs, raw material costs. Seems to me that the emphasis has shifted here away from just the cyclical upswing and towards maybe margin pressure. How are you processing that, Stephen?
We are really trying to think that through, and that's a great debate inside the firm. One, in terms of inflation, but when you look at commodity prices, to what extent that's just kind of passing through because of lack of supply we've had over the course of the last year, or to what extent that's going to be more permanent. At this point, we think it's passing through. We think supply will catch up, but that's an open question and something we really have to keep an eye on.
Stephen, it's good to catch up and good to hear from you. Just to get some insight to the conversation you and the team are having at Franklin Templeton. Stephen's over there. Troy Gajewski will be sticking with us. Let's head back to the market desk and get some movers at the market desk with Abby.
Well, John, we've been talking all about tech and earnings this morning.
Guys, let's place stop on profit for euro. The price I'm going to place at 120.67.5. Okay, it will give us 2 pips. Will be enough to secure if anything will happen with this pair. If it decides to change direction and move up, we will close this trade in profit. Okay, guys, stay safe.
Steel company is higher, and then 3M, which you've been talking about, those rising input costs yesterday, down because of that. Today, bouncing back just a little bit. It's going to be interesting to see how this debate does play out, whether or not it can be absorbed. But one thing there's no doubt about, if we take a look at commodities on the year, absolutely soaring. Copper up 27%, corn up 34%, and there it is, lumber up 79% on the year. Incredible.
What a rally. Abby, thank you. Much more from Abigail Doolittle. Through the open, about 11 minutes into the session, equities doing okay. A little bit later, the sector price action with Abby. Up next, Bitcoin absolutely ripping. And Troy Gajewski of Skybridge Capital taking a big position and allowing it to grow into a decent slice of his broader portfolio. We'll talk about why next. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
One of the interesting features about this illness is that if you look at it, the people who develop these long-haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, it means you probably mounted a very strong immune response, okay? And you recovered from the illness, you probably got rid of the virus. if you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, oh, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
There's always the chance that there's sort of volatility, but as a reminder, I mean, Bitcoin is the best performing asset class of the last 10 years, and so we remain bullish that this is a great, compelling product for users.
Bitcoin surging 80% this year alone. Violent price swings doing little to sway interest, with Wall Street now moving to advance crypto offerings for clients. JP.
Okay, guys, position close on Euro at 120.67.5. We made again £200 in profit. If you follow the trade, our trade, you probably made as well profit. Broker send you already confirmation how much profit you made. Okay, let's move on to another pairs. Don't forget we hold Bitcoin. So hopefully we will sell it today. If not, I'll be happy to hold it overnight for better profit. For more information how we trade or to get a strategy, please go to company.co.uk website, or you can find our strategy on our streamer. You can see a red line ticker over there. You can find the information how to get our strategy. I'll speak to you later. Stay safe.
Started as a joke, enjoys a market cap of $40 billion. That is the reality of this moment in time. And if you look at the returns on cryptocurrencies themselves, yeah, they've been juicy, but it is nothing compared to the upside you would have gotten if you invested in crypto-tied equities over the last year. Galaxy Digital Holdings up nearly 3,000%, Marathon Digital by 7,600%, and John, Humble, which is a data transactions company that uses blockchain, is up 323,000%. I'm just going to leave it there because I think that number speaks for itself, John.
Unreal, it does. Katie, thank you. Troy Gairsky saying it's highly unlikely that Bitcoin has seen its top. He writes the following: Bitcoin is still the best macro trade. Don't sweat the volatility. Troy's back with us for more. Troy, we've had an ongoing conversation about this over the last couple of weeks. Just build on that. Don't sweat the volatility. Why?
Well, look, I mean, the reality of cryptocurrencies and even Bitcoin, which is by far and away the largest and deepest, is that if you make an investment today or you make an investment in early December like we did, you have to expect multiple 20 to 30% pullbacks in the bull market phase. And you also have to realize that perhaps all your analysis is incorrect and you don't have nearly as much upside this cycle as you did the previous two. But that being said, I mean, the combination of still extraordinary money supply growth, we still think we're in the early innings of the adoption cycle. As you mentioned JP Morgan and Morgan Stanley and Japanese gaming companies getting involved. And we're still, this bull market is still younger than the last two in terms of length. And we could see many rational reasons why there's less upside this time around, and it's a longer bull market. But it's really hard to argue that it's going to be a shorter bull market. There's really no fact or basis for that, in our opinion.
Troy, how do you make the decision how much of the portfolio should be dedicated to it, and your tolerance levels around how much you allow it to grow into the overall portfolio? How are you making those decisions? What process do you go through?
That's a great question, John. And so, look, initially, it's based on how much at cost you're willing to risk. Like any investment, right? We view it as any other theme. If you're wrong on the thesis, if you have some type of exogenous shock, how much are you willing to risk? And, for us, we had roughly a 5.5% at cost position at a weighted average price of about 18,500. And then as it grows, for good reason, right, due to outperformance, you have to manage it relative to other exposures in your portfolio. And this is very important. You have to look at what your mandate is. And remember, our mandate is to generate the best absolute and risk-adjusted returns with as low a beta and correlation as possible to other assets. And so what we've seen is with the addition of Bitcoin, our beta was already low. It's gone down even further, even though our mark-to-market volatility, which we think will be more in the 8 to 12% range versus 4 to 8% range, has gone up. So it's an interesting dynamic, right? You're increasing expected return, you're increasing mark-to-market volatility, but you're also simultaneously marginally decreasing your beta and correlation to other assets. And so if that's your mandate, you're continuing looking at that relative to other opportunities in the portfolio. And right now, again, when we look at other asset classes that are liquid, that we think have significant upside, we just don't see anything that could potentially double by the end of the year. Now, that's not to say individual stocks or late-stage privates can as well. But this is the liquid market, right? You can evolve the position, you can trim it. We've made the decision not to add to it further, even in pullbacks. But liquidity is a very important aspect of this as well.
Troy, I'm very interested in the investor conditioning that we're going through right now with this asset class. And I just wonder what we'll think it's most useful for in the years to come as we go through that conditioning. And I think a great example is the Japanese yen. Anyone that comes into financial markets is often asked, why is the yen a safe haven? And he can sit there and talk about how it's used as a funding currency. You can talk about Japan's maybe net foreign asset position as well, how that's positive. But Troy, when it comes down to it, it's because it works. That's ultimately why you consider the Japanese yen a safe haven, because it works. And I just wonder how Bitcoin will be used in the broader portfolio as an asset class in the years to come as we go through that conditioning.
Yeah, look, and that's where the parallels to gold are so important, at least from our perspective, in that, gold was a completely orphaned, under-owned assets for years, really since the early to mid-'80s through the late '90s. And then it went through an adoption cycle, and whether it's hedge funds or asset allocators decided, hey, you want 0, you want 1, you want 2, you want 3%. We'd expect, again, as this marketplace matures, that Bitcoin will be the store of value winner, right? We don't ascribe much value from a transaction standpoint. We hope we're wrong. There are many smart people that think that has tremendous transaction value use. But we think it's going to be the dominant store of value, the digital gold. And then Ethereum and digital fiat currencies will be used more for actual transactions. That's how we see it shaken out. And so the question as an allocator, right, is right now, if you're concerned about a currency debasement, if you're concerned about the potential for more meaningful inflation, you obviously see asset inflation before your eyes and everything. You mentioned copper and wheat and lumber. My goodness, if you're concerned about that at all, you don't have that many liquid choices. One would obviously be gold. 2 would be Bitcoin. And the marginal flow dollar is clearly going into crypto because gold already had its adoption cycle. That being said, we are surprised gold is off from its August high. I wouldn't have suspected that. Why sell gold to buy Bitcoin when you can there's so much cash out there? But that's been the price action, of course, the last 4 months.
I'm trying to keep an open mind on a topic.